Okay, sorry for the glitch. I hope you can hear me now. Guys online, please confirm that you can hear me. Okay, so I was saying that this number one is specifically going to be on computation of income tax liability. On computation of income tax liability. Now, I want you to open your question banks and look at number one. Just open your question banks and look at number one. And I'll use an example here as we also look at your number ones. Whatever you have, as long as it is number one. Okay. You're going to be given number one, and on the number one that you're going to be given a statement of profit or loss. Who doesn't see a statement of profit or loss? Now, there are things that I want you to master now. When they give you a statement of profit or loss, or whatever number they have given you, mark the following things. Number one, you must know the industry that this entity is operating in. And I'll tell you why you need to know the industry that this entity is operating in. So they are giving you an entity that is doing business, but you must ask yourself, what kind of business is this entity doing? I'll give you examples of the common things that they are going to ask you. You can have an entity that is trading in general things, or you could have an entity, for example, in manufacturing. You could have an entity in the banking sector. You could have an entity in agriculture. You could have an entity that is doing mining. So all those entities have some small things that the examiner will be looking out for. So I'm going to comment on some of those specific sectors that you must be aware of when you see them. For example, when they bring you an entity that is in the manufacturing sector, then you know that you're going to have, when you're drawing your wear and tear schedule, you're going to have assets in class 2. I am going to repeat some of the things. When you have an entity that is in the manufacturing sector, you're going to have assets in the wear and tear schedule falling in class 2. You won't avoid that. If you have an entity that is in farming, there are certain things that you will remember. Number one is that it will have some assets in class 2, but it will also have some assets in class 3. Now, if you look at the assets in the farming industry, are different assets in the manufacturing industry, are different assets in the general trade. So it is very important, number one, to know the industry, and I'm going to comment on the industry so much. If you're dealing with the banking sector, for example, the financial institutions, you know they are going to ask you about provision for bad debts, and at this point, they will be allowing specific provisions for bad debts, because it is the only unique thing that is in the financial industry. We know that provisions for bad debts are generally non-allowable. But when it comes to the banking sector, to the financial industry, the specific provisions become allowable deductions. When it comes to farming, there are about 3 things that you must remember when the industry is farming. Number one, you have to remember things called farm works. I'm very sure in your studies you learned about farm works. Farm works include things like labor quarters. It includes things like fences. It includes things like drips. It includes things like electricity supplies on the farm. So farm works got class 3 of the wear and tear schedule. So if you're doing a number on the farming industry and they are telling you that these are farm works, you know that you have to take them to class 3 of the wear and tear schedule. I'm just still giving you a few highlights. In the farming again, there's what we call horticulture plant. There's what we call horticulture plant and greenhouse. I am very sure in your practice you have seen these things. So horticulture plant and greenhouse don't go to the wear and tear schedule, but they are given a capital allowance of 20% on the costs. Now, again, under farming, there's what we call farmhouses. There's what we call farmhouses. Farmhouses are industrial building, meaning you're going to calculate IBD on farmhouses. Let me repeat it for farming, because I don't want the examiner to bring an item in farming and then you're wondering. So in farming, basically there are about 4 things that you must remember. If the number they have given you is in farming, 4 things. Number 1, you are likely to have assets in class 2, because class 2 accommodates plant and machinery used in manufacturing, farming, or mining. So it means if the industry they have given you is manufacturing, is farming, or mining, then you prepare your mind to ensure that some assets will fall under class 2 of the wear and tear schedule. If it is farming, you remember more 3. What are the 3? Number 1, farm works. And I said farm works, the common item in farm works is called labor quarters. They might sound as buildings, but they are taken to class 3 of the wear and tear schedule. Now, in addition to the farm works, there's what we call horticulture plants and greenhouses. All those seem to be houses that you might think you want to calculate IBD, but we don't give them IBD. We give them a capital allowance of 20% without calculating any IBD, without taking them to the wear and tear schedule. So if it is a horticulture plant or a greenhouse, you don't take them anywhere, but you give them 20% as capital allowance. And every capital allowance you calculate, you take it to the tax computation, as we're going to see. The other item under the wear and rather under farming are farmhouses. Farmhouses are industrial buildings, meaning you're going to calculate 5% of their cost. And if you're going to apportion, you apportion using the number of days, the way we do the IBD. Out together with farming, I now cross to the financial industry. I say the common item under the financial industry is the specific provisions for bad debts. Now, under the financial industry, we have what we call general provisions and the specific provisions. Now, you realize that when we are dealing with all other general businesses, every time you see a provision for bad debts, you add it back. But when it comes to financial institutions, there are exceptions. The financial institutions has both, or have both general provisions and specific provisions. So the only item you're going to add back are the general provisions. The specific provisions, you don't touch them. They remain where they are in the okay? Okay. Okay. So we have talked about the financial industry. We've talked about the manufacturing industry. We've talked about the farming. You have a question that is going to give you a statement, profits, or loss. A statement of profit like this, one must earn them. Now, the statement of profit or loss has incomes and also has expenses. By whatever industry they are going to give you, you're going to find that your statement of profit or loss has incomes and also has expenses. Now, businesses do not only operate with incomes and expenses, they also operate with assets. So your number is going to have incomes, is going to have expenses, but it is also going to have assets. You must know what you're looking for in those three items. Now, when it comes to incomes, because this business has described to you what forms of incomes it has earned. And largest revenue, by whatever name they call it, sometimes they call it revenue, sometimes they call it turnover, sometimes they call it, for example, income. If it is a financial institution, don't look for turnover, don't look for revenue. You like it actually have one item called income. And it is also going to have expenses. Now, when you're looking at incomes, what we test in the incomes is a student being able to see that the income in the statement of profit or loss, that for me, I have told you the income that I have recognized in the statement of profit or loss. But taxation rules dictate which of the incomes are taxable and which of the incomes are not taxable. So we are looking into the incomes that they have given us to be, and then to go in the tax computation and remove. So before you examine the Your Honor, as we discussed, list the items called income so that in case you see it, whether you understand why you put subtracting it in the computation or not. So as you summarize your final touches, summarize the incomes that are not taxable so that when you see them in your statement of profit or loss, you go to the tax computation and remove them. Because we are saying, whereas the accountant has included them in the statement of profit or loss, they should have remove them. And we're going to see how to remove them. For expenses, you're saying the business will record everything, including errors, by the way. And in the exam, we do what we call deliberate errors. We put certain expenses that are not actually expenses. Either we bought an asset and put it in the expenses. We actually incurred some private expenses and also put them in the expenses. Because we are trying to test the student whether they are able to differentiate expenses of the businesses and the expenses that are not relevant to the business in one or the other. So the expenses, you're looking at expenses that were included. These should not be expenses, and we want to add them back in the tax computation. Now, whenever you have an exam, you also have a list of assets, because we said we are looking at three things: incomes, expenses, and the assets. What am I looking for in incomes? I am only looking for incomes that should not be, and that is what I take to the tax computation. Any income, I'm not bothered with it. I am only looking for incomes that should not be taxed. When I'm not looking for anything non-allowable deductions. Non-allowable deductions, they say these should not be claimed. They should not be used income. We'll first come and show you this is my income, these are my expenses, and my end result is the profit. Now, in the statement of profit or loss, usually there are so many profits, starting with gross profit. Do you know where the gross profit is? When you get sales minus cost of sales, you first get to the gross profit. That is not what we are looking for, because that is not what we tax. You move the next profit that you normally find, interest and tax. Again, that is not the profit we are looking for. After you have removed interest, what you call finance cost, you normally get what you call the profit before tax. Now, the profit before tax is what we want to tax. I want you to look at an example like this. When you see items like this, one, you're seeing gross profit. Is that what you're looking for? No. When you're looking at operating profit, is that what you're looking for? No. But we have the profit after you have removed interest or finance cost, the profit that we are calling profit before tax. I think that you declare to us in your profit or loss was correct. The taxman would want to tax this profit before tax. The taxman would want to apply the tax on that profit before tax for him to be able to get the tax liability. But the taxman is saying, not yet sure whether what you included in incomes, what you included in expenses to get that profit was actually according to the tax rules. Profit. But can I also calculate my own? Now, what you're going to be looking for is the profit. The accountant has given you the profit for tax. That is what you're looking for, by the way. But what you're not with the accountant, you want to question his expenses. You want to question his incomes. For example, a number like this. His incomes are in gross revenue, but also in other incomes. So if I am looking at testing this gross revenue,
Okay. So
When you see the expenses, you're going to see a number of notes on the expenses. But also make sure that you look at the expenses, first of all, on the face. Is there anything glaring on the face where the examiner has not put a note, but I am aware it is a non-allowable deduction? It does not mean that the examiner is going to put a note on everything. I have seen exams where the examiner has not put a note, but it is an item that is non-allowable. So do not claim that everything the examiner wants you to adjust is going to have a note. But largely speaking, everything that requires an adjustment, the examiner is going to put a note. Now, he has given you a list of expenses, but these expenses are summarized. He says, for example, I have distribution costs, I have administration costs, I have other expenses. But the question is, what is actually included in those expenses? That's why he tells you, when you want to know the breakdown, look at note number, for example, note number 3 for distribution costs. But as you look at the details of distribution costs, look out for expenses that are not supposed to be allowable deductions and take them to the tax computation. So we are looking for only expenses that should not be allowed as tax expenses, and then we are adding them to the tax computation. Now, when we get to the other information, additional information is just a breakdown of what they have given you in the summary. So do not be confused by the additional information. They are only telling you that this summary that you have on the statement of profit or loss is not enough to give you the whole picture. So you read the additional information to know what exactly is included in the items in the statement of profit or loss. For example, note number 1 was talking about revenue. Here they are breaking for you revenue. As you're looking at that revenue, what are you looking for? These are all items of revenue, but you're only looking for incomes that should not be taxed. And those are the ones that you're going to take to the tax computation and remove them. When you're picking income here, you must remove it in the tax computation. When you choose that you're picking income here, again, don't go to the tax computation and add it back. The incomes picked here must be subtracted in the tax computation. Why are you subtracting them? Because you're saying, I don't want to tax them. Anything you don't want to tax, you subtract it in the tax computation. So when you pick any income here, again, don't pick it and then you go and add it back. You go and subtract it. I hope that is now understood. When you get to the expenses, the treatment in the tax computation is add it back. And the only expenses you're going to add back are the expenses you're satisfied are not allowable deductions. Allowable deductions are expenses that you have satisfied should be expenses of the business. The accountant has already allowed them, and you as a taxman, you're also comfortable that they should be allowable expenses. Those ones, you don't touch them. What you're looking for are expenses that the accountant has included in the statement of profit or loss, but are not supposed to be allowable expenses. And you go to the tax computation and add them back. Now, other than the incomes and expenses, we said they are also going to give you assets. When they give you assets, we are looking for capital allowances or capital deductions related to the assets. So what are those capital allowances or capital deductions you must be aware of? The main ones are 2. You're going to be dealing with the depreciation allowance, or what we call the wear and tear allowance, or you're going to be dealing with IBDO, industrial building deduction. Now, we say they are giving you 3 things: incomes, expenses, and assets. What are we looking for in assets? We are looking to calculate the relevant capital deductions. And the relevant capital deductions in your exam, you are likely to be calculating the wear and tear allowance, otherwise called depreciation allowance. And you're also going to be calculating industrial building deduction. Now, all other assets other than buildings and land, will go to the wear and tear schedule. All other assets other than land and buildings will go to the wear and tear schedule. And when they go to the wear and tear schedule, you'll be looking for one item called depreciation allowance or wear and tear allowance. So by now you should be able to know how to draw the wear and tear schedule. And how do you know that you should be drawing the wear and tear schedule? By looking at, for example, a note like that. Do you see that note that has classes? Automatically your mind should know that this point is for drawing the wear and tear schedule. So before you enter the exam, just know the format of the wear and tear schedule. In the format, you already have 3 marks because you're going to pick these opening balances the way they are and take them to the wear and tear schedule. And then when you get opening balances, you also have additions. Additions are the assets that you have purchased in that year of income that you're dealing with. So after the opening balances, definitely you add in the assets that you purchased. So your strength as a student is knowing which class plays the assets. And I am requesting before you get into the exam, please know which assets go to class 1, which assets go to class 2, and which assets go to class 3. The other thing you must remember is they're not going to give you percentages of the classes. I have seen students they did not mind about the percentages. They get in and get confused, especially if you're redoing this paper or you have been practicing past papers. Because if you've been practicing past papers, in the previous period, we had 40%, 35, 30, and 20. There were 4 classes. They have since changed. They are only now 3 classes, meaning you're going to have class 1, class 2, and class 3 with 40, 30, and 20. So don't get into the exam when you don't know what the rates are. Now, in addition to additions of the assets, you're also going to have disposals. Because in the wear and tear, we have the opening balance, we have additions, and we have disposals. You don't charge depreciation unless you have the net assets. Having the opening balances, add additions, remove disposals, and then the balance is what you charge those percentages. So you must know the additions, you must know the disposals. That is in the wear and tear schedule. And the examiner is giving you all this. He's giving you the opening balance. He's giving you the additions. He's giving you the disposals. Yours is calculate the net. After getting the net, apply the percentages. If it was class 1, apply 40%. If it's class 2, apply 30%. If it's class 3, apply 20%. You're applying to do what? To get what? Depreciation allowance. Once you get that depreciation allowance, take it to the tax computation and remove it because it is an allowable deduction called the capital deduction. Are we together? Now, you will also realize that in the same exam, other than giving you other assets, they could also give you buildings. They could give you buildings. When you see the building, you know that the examiner wants you to calculate IBD, industrial building deduction. Now, as you're looking for this building, there are certain things that you must remember. For you to calculate IBD successfully, you must know the percentage of IBD. What is the percentage of IBD? 5%. You must know that percentage is applied on what? It is applied on the qualifying cost, or what we call the capital expenditure. So it is 5% times that qualifying cost. The only question is that 5% represents the whole year. If that building has not been used for the whole year, it means that 5% must be time apportioned. And you apportion it using the number of days. That's why you get the 5% times the qualifying cost times now the apportionment. The apportionment is number of days this asset has been used over 365
days. You're only apportioning using the number of days, nothing more. Otherwise, if this asset has been used for 12 months, you're only applying 5% on the qualifying cost, and that is it. Is that hard? No. Now, again, on the face of the exam, remember we are looking at the free marks. We have seen on the face of the exam, you're going to have a POL. What are you looking for in the POL? Incomes and expenses. When you're looking at incomes, you're looking at incomes that should not be taxed. When you're looking at expenses, you're looking at expenses that are non-allowable. When you go to assets, you're looking for depreciation allowance in the wear and tear schedule and industrial building. The other items that you're likely to see on the face of the exam are credits. And these credits include the withholding tax credit, the provisional tax credit, or any foreign tax credit. These credits only come after you have computed your tax. So provisional tax that you paid, withholding tax that they withheld from you, or any foreign tax credits will only come after you have done your tax computation, you have your tax liability, and you're only removing it because you have already paid. Credits are income are taxes that you've already paid. So they come at the very last end. Okay. Now that we know that we are going to have number one as our tax computation, I am now going to take you through how this tax computation flows. So that when you actually see the number one, you first draw that format. When you draw that format, remember the question is asking. This is what the question is, we'll always ask. It says, for example, in this, advise management on the chargeable income. Ladies and gentlemen, chargeable income is this profit. Is this profit? Where is the profit in the POL? Chargeable income is this profit that you see here. The profit that we are talking about, profit before tax, this was determined by the accountant. Now, with the adjustments that you have made on that profit, can you determine your own profit? And that profit is what you call chargeable income. So the word chargeable income is the revised profit of the accountant. And the revised profit is that if they have given you a profit of 29, if you discover that some expenses were not supposed to be deducted, you added them back. If you discover that some incomes were not supposed to be taxed, you subtracted them. If you calculated the capital allowances on the assets, you subtracted them. And then you have an adjusted profit. We are calling chargeable income that you're going to apply the tax. Now, when you get into the exam, ladies and gentlemen, this is what you're going to do. I hope you can see this. Can you be able to see that? Do I need to expand it? Some people's eyes might not be as sharp. Someone is saying I share the screen. I thought the screen was shared. Please confirm if you can see the screen now. Can you see the screen now? Okay, good. Now, all of us are going to do number one because it's comparison. So from now, Kuram, if you cannot understand how your number one is going to be. Number one has certain headers. Number one has certain headers. So as you enter the exam, make sure that this format is in your head. So what are the headers? You must be seeing where number one, number two, number three is. Okay. So I have entered the exam, and my number one is on calculating chargeable income and tax payable. I first asked myself, am I dealing with an individual? Am I dealing with a company? Largely speaking, your number one is likely to be on a company. But even if it is on an individual, the difference is not big. The difference only comes when you're actually calculating the tax liability. That the company applies 30%, whereas individual, you go to the individual income tax rates. Those rates that we're going to use for employment income are the same rates you use for individuals, any individual number on income tax. Now, the first line, everyone must pick that mark. At least if you're going to get 0 in this exam, don't get 0. You have a mark to pick. And this mark is coming from the statement of profit or loss that they have given you, which is the profit or loss before tax. I am not talking about gross profit. I am not talking about operating profit. I am not talking about profit after tax. I am talking about profit before tax. Now, even if they named it anything, even if they called it net profit, even if they called it net loss, but know that that is the profit before you apply any tax. That is what you're going to start with in the tax computation. So my assumption is you draw 3 columns. In your tax computation, you draw 3 columns. Column number 1 is what where you're going to be putting your items. This is the description, the particulars, whatever you want to call the heading. We don't mind, we don't mark the heading. Either you call it particulars, you call it a description, you call it whatever. So that is going to be your column number 1. Column number 2 is what you're going to be putting the figures of the details. Whatever you add back, whatever you subtract, you put it in column number 2. And then the totals, you put them in column number 3. Now, you start with the profit or loss before tax. If it is a profit, you bring it as a positive and put it in the last column. If it is a loss, you bring it as a negative and put it in the last column. This profit is going to be affected by 2 things for you to get to the chargeable income. It is going to be affected by the expenses that you added back and the items that you subtracted. So I have the add backs and I also have the allowables to be able to get to my first item called chargeable income. So if I get my profit number 1, profit or loss before tax, which I'm extracting from the statement of profit or loss, I add back the non-allowables. Ladies and gentlemen, non-allowables are coming from the statement of profit or loss as expenses. They are coming from where? The statement of profit or loss as expenses, which you have decided are not allowable expenses. That you're saying the accountant shouldn't have removed them. I want to add them back. So if you find you're adding back something that did not come from the profit or loss, then you're doing a wrong thing. Because how can you add back what was never subtracted? That is one. So you list all the add backs. We are going to see them, examples of them that you're going to meet. And then afterwards, you also look at less allowables. Now this is where confusion is. When we say less allowables, we are not talking about expenses. We are not talking about expenses. When we say less allowables, we are not talking about expenses. So do not go to the statement of profit or loss and pick the expenses that you had already qualified as allowable and then bring them here. That is not what we are talking about. In this line of allowables, we are basically looking for about 4 things, and remember them if they are not 5. These are the things that are going to be mixed under less allowables. Number 1, incomes that are not supposed to be taxed. Incomes that are not supposed to be taxed. And we're going to see those incomes. that the examiner included them in the statement of profit or loss, but you're satisfied that they should not be taxed, they should not be included in the gross income. You want now to remove them. And what are those incomes that you're going to see? Now, this is where cram work starts. Number one of the incomes, I'm going to list them as we come in here, but I want you to remember them. One of the incomes are incomes that we call exempt income. The moment the examiner tells you this is exempt income, and he has again included it in the POL, you're saying no, exempt income should not be taxed. So I want to remove them. Number two, you have a list of incomes that are actually not cash moving items, whereas the accountant can recognize them in the POL, but they are not actually actual items. We call them book incomes. For example, things like unrealized foreign exchange gains, things like reduction in provision for bad debts, things like gain on disposals. All these are book entries in the statement of profit or loss, but they are not actual incomes. Accounting rules allow you to recognize them as incomes, but they are not actual income. So I want to remove them. So I talked about exempt income. I talked about incomes that are not actual, and then rental income. Rental income. And then we also have incomes that have suffered withholding tax as a final tax. All these are going to be in the POL, but are they taxable? No. So what do? You bring them in the tax computation and remove them. That is category number one on incomes. The expenses that are coming in the allowables are actually capital deductions. And why are they coming in there? Because we don't see capital deductions in the POL. It is only the taxman that knows about capital deductions. So the accountant has not yet claimed these capital deductions. That's why when you have your IBD, that's when you have your depreciation allowance, you come and subtract it under allowables. And then once you have subtracted all allowables, you'll be getting what we call your chargeable income. Don't worry, I'm going to go to each of them. But I'm now looking at headers. We started with the profit or loss before tax. The second heading was add back non-allowables. These are expenses that are coming from the statement of profit or loss that I'm satisfied should not be allowable deductions. I'm adding them back. We get to the next heading, less allowables. It is a mixture of incomes and deductions. But these deductions do not pick. Now listen properly. Do not pick an expense from the statement of profit or loss and bring it under allowables. Do not pick an expense from the statement of profit or loss and bring it under as allowables. I think that is clear enough. I am repeating this because I have seen this is the biggest error that students make. Do not go to your statement of profit or loss and pick an expense and bring it under less allowables. Okay. Now, after getting your chargeable income, remember the chargeable income is as a result of three things. The profit or loss before tax, add back non-allowables, subtract allowables. The line is called chargeable income. You're close to the answer now. The only item that reduces your chargeable income is called a carry forward loss. It is a free mark because you're not going to calculate this carry forward loss. The examiner is going to tell you among the notes that there is a loss that came from the previous year. That is what you call a carry forward loss. At this point, remove it from the chargeable income, and then you get your adjusted chargeable income upon which you're going to apply the tax. Now, when you get your adjusted chargeable income, this is when you start asking, am I dealing with a company? Am I dealing with an individual? If I am dealing with a company, I automatically apply 30. please be careful. If your chargeable income is the negative, please don't apply 30% because we don't tax losses. That is what you call the assessed loss, which will be carried forward in the next year. You're not going to be there to carry it to the next year. But for now, you're showing the examiner that I'm not applying the 30% because I recognize that I have a loss. Whether it is correct from your computation or not, as long as what you have got is now a loss, do not apply the 30% or do not apply the tax because we don't charge tax on the losses. But if it was a positive, then you apply either 30% or if it is an individual, you go to your table of individual tax rates. They are going to give them to you. I hope by now you know how to apply those rates. So pick the chargeable income, apply it on the rates, and bring the tax as is. Now, when you have finished that, there is this one unique item. This one unique item. Please don't cram that because it is unique as it is. You will only remove that 2% on the tax payable only and only if this entity you're dealing with is employing persons with disabilities that form at least 5% of the full-time employees. If you're not dealing with a number that's with a company that has persons with disabilities, that 2% is irrelevant. So do not calculate it. Are we together? So it means if you apply 30% and got tax payable, this is the tax they are demanding from you. The next question is, have you paid any tax in advance? In form of foreign tax credits, in form of withholding tax credit, in form of provisional tax credit. All these, they are going to give them to you straight. If there is withholding tax, they are going to give it to you. If there is provisional tax, they will give it to you. If there is any foreign tax credit, they will give it to you. Your role is to remove it and then get your tax liability or your outstanding tax liability. Now, I am going to go back to these items so that I remind you about the things you're going to remember as add backs. So that when you see them, you automatically add them back, whether you understand why you're adding them back or not, but you must add them. Are we together? Because at this point, I cannot purport to be saying I am going to teach you why we are adding back certain items or why we are subtracting certain items. Though I'm going to hint on them. Now, when you get to the tax computation, rather to the POL, I want everyone to pass the depreciation. I want everyone to pass. So whether it is organized, we just go to your POL in additional information. If it is not on the first, it's definitely to be in additional information. And usually it is an administrative expense. But wherever they have categorized it, as long as you see depreciation, and you must see it, because I've not seen an exam where there's no depreciation. So you must pick that depreciation and come and add it back. You will understand why you're adding it back after the exam. But you must add it back. You must add it back. How many marks do we have now? 2. Because you picked the profits, they gave it to you or a loss. You have brought it back. They have given you depreciation as a must. You have brought it and added it back. So what are the other items that you're going to actually have? Any expense that you see, and the examiner has called it entertainment expense and added nothing to it, come and add it back. In business, we don't allow entertainment, just entertainment. If there is an exception to it, the examiner will actually tell you that exception. Now, the next item is called expenses related to exempt income. That is in the case that you have discovered that there is exempt income in the POL. The moment there is exempt income in the POL, first of all, that exempt income is going to be subtracted in the tax computation. Now, the examiner will also tell you the expenses that are related to this exempt income are this much. So as you subtract the exempt income, add back the expenses related to that income. Because if you are not taxing the income, why should we allow you the expense? The next item is, this one is very common. This one is very common. Now we have also what we call book. We have book expenses. The expenses that you do not part money with. For example, you part money with money to pay for depreciation. You don't pay for depreciation, but it is recognized as an expense in the POL. The taxman does not allow you an expense where you're not going to part with money. So a loss on disposal is a non-allowable deduction and must be added back. So whenever you see a loss on disposal, add it back. I want first jump the balancing charge. Donations. Guys, donations, just put it in your head that generally we do not allow businesses to make donations. We only allow them in exceptional circumstances. Now, the only time you're going to allow a donation is when it has been given to these 5 entities. So whether the examiner is going to confuse in whatever way, when you see a donation, ask yourself, has this donation gone to these 5 entities? Number 1, an amateur sporting association. Number 2, a charitable organization. Number 3, a religious institution. Number 4, an educational institution. Number 5, a research institution for not-for-profit. When we get to educational institution, it must be for not-for-profit. In other words, we are talking about government institution. And the catch point here is that all those institutions that we've talked about, for you to remember, is that the examiner must tell you that they have a certificate of exemption. So if you forget the entities, at least look for the certificate of exemption. If they have told you that this entity has a certificate of exemption, already it should remind you that it qualifies, not so. So you might not remember all those entities, but remember one word: certificate of exemption. If the donation is given out an entity that does not have a certificate of exemption, that donation becomes the non-allowable deduction. Go and add it back. Now, if it has a certificate of exemption, you'll also have to make another test. Does this donation exceed 5% of the chargeable income that you have? The chargeable income before you make any adjustment on that chargeable income. So if that donation is over and above 5% of that chargeable income, you're going to disallow the excess. So how do you know that it is in excess? You first get that chargeable income, this very chargeable income. Do you see this chargeable income? This very one before the adjustment. This chargeable income. You get that chargeable income, the donation that is in the POL that you want to actually allow or not allow. So you get that chargeable income, add back that donation, first get the total. The total you get, apply 5%. When you apply 5%, that 5% gives you the maximum donation that you can give out. Now, that you have calculated, compare it with the donation that was charged in the POL. If what was charged in the POL is more than what you calculated as 5%, it means you gave out excess donation. And the excess is what you add back. Have you understood that? Good. The next item that you will remember is provision for bad and doubtful debts. The moment you see that in your expenses in the POL, automatically come and add it back. The only time you're not going to add it back is when you're dealing with a financial institution, and they must specify that that is a specific provision. But generally, provision for bad debts are going to be added back. Are we together? Next is, now, if you have not been paying attention, pay attention to startup costs. Startup costs can fall in the add backs or they can fall under allowables. So you must know the circumstances under which they are going to fall under add backs under which they are going to fall under allowables. I'll start with add backs. We said, first of all, you cannot add back what was never subtracted in the POA. So it means by the time you put startup costs in the add backs, you're satisfied that it was coming from the PO. So do not add back startup costs if you did not find it in the POA. Now, the reason you would add it back now is because you're saying the accountant has claimed startup costs as expenses at 100%, yet the law only allows 25%. So what percentage are you adding back? Only 75%. Because you're saying, I have seen it in the POL, but the rules of tax say you cannot claim 100% of it. So I want to deny you 75%. So I calculate that 75% of what you're claiming in the POL and add it back. That is the only time you add back startup costs. When did you put startup costs under less allowables? You put startup costs under less allowables if they were not claimed in the POL. You could have a note that says, in addition to the expenses in the POL, the entity or the company also incurred startup costs. But the accountant has not yet claimed anything on the startup costs. Yet the law says that every time you incur startup costs, you will claim 25% of those startup costs for the next 4 years. 25% for this year and then the subsequent 3 years. Meaning, if they gave you startup costs and the accountant has not claimed anything on those startup costs, you give this tax computation what percentage? What percentage? 25. So I calculate 25% and then allow it under less allowables, because that is the creature of the tax law. It is the taxman that is giving me that deduction. Did the accountant claim anything? No. This is the time now to give this company its startup costs only to the tune of 25%. Okay. The next item that you will see, largely speaking, is provision, rather unrealized foreign exchange loss. Now, don't be confused, because the examiner could give you realized and unrealized. We are only looking for unrealized. He's going to give you, because the questions I've seen, sometimes he gives you realized and also unrealized. The only item you're looking for is unrealized foreign exchange loss. Don't start the realized. The next one is, this one is now the biggest part. Expenditure or loss of domestic or private nature. Now this year you must use your brain. They have told you this is the business. And the expenses that you see are going for the private persons. The directors, they have spent on the director, they have spent on the staff, they have spent on things that are not related to the business. The things that are not related to the business are what we call expenses of domestic or private nature. And if you actually see in your questions, the most expenses that you will see, number one, for example, school fees. You're a company, but you're paying school fees for the director's children. MD's personal expenses that they are giving the MD allowance because he has to hang out in a Rotary Club, he has to hang out in Kampala Club, he has to log out. Those are private expenses. That you're paying some expenses at the MD's residence. Those are private expenses. Funeral expenses, they have made contributions. Someone has died and they are making contributions for funeral. They have incurred some expenses. Holiday expenses, they are incurring some expenses for holiday. Sponsorships, they have sponsored them. Is it called the Nkuka? Yomark. They have sponsored the Kawakazu Run. They have sponsored the whatever sponsorships they are. Those are non-business expenses. Things like this subscription to non-professional clubs. If they subscribe, for example, to Uganda Manufacturers Association, that is business. If they subscribe to Uganda Hotel Association, Hotel Owners Association, that is business. So you're looking for non-business or professional subscriptions. Things like bribes, things like general expenses not supported by relevant documents, things like dividends to shareholders. All these are expenses of domestic nature. So look out for them because they are very common and the examiner is going to put them in. Now, the other item that I want you to be cautious that can give you more than 2 marks are capital expenses. We know that when we are preparing a statement of profit or loss, we don't include in capital expenditure. Capital expenditure is supposed to be an item in the balance sheet, not so. All capital expenditures are supposed to be items of the balance sheet and not items of the PO. But in the exam, we are going to put items of capital expenditure in the POL because we want to test whether a student is able to know that capital expenditure does not go to the POL but rather goes to the balance sheet. Now, a capital expenditure will result into an asset. Not so. A capital expenditure will result into an asset. So if they actually put it in the POL, mistake number 1 is they have put it in the wrong place. So how do I correct it? I add it back. But because it is resulting into an asset, I must ask myself, then what capital allowance do I give this asset? I'll give you an example. I purchased a motor vehicle, but the expense is in the POL. I purchased an equipment, but the expense is in the POL. So what do? I actually put it from the POL and add it back. And I'm saying you shouldn't have claimed a capital expenditure. The question is, do I stop there? No, because this is now an asset. Then I ask myself, where do I put this asset? If it is a depreciable asset, a plant and machinery, I go and look for where it falls in the wear and tear and place it there. If it is a building, I then calculate IBD on it. Do you see how you earn 2 marks? Because you have a mark of adding it back as an expense that was not supposed to be deducted in the POL, but you also have a mark because you're considering it as a capital expenditure and giving it its capital allowance, whether depreciation allowance or IBD if it is a building. I hope you've understood that. The next item is you're going to make certain losses. For example, safety, for example, fires, getting your lost stock, etc. Those are business losses. And ideally, they are allowable deductions. But if again they are covered under insurance, if you will recover the loss, then we can't compensate you again. So if you lost your stock, if your stock got burnt, if it is not insured, it is an allowable expense. But if it is insured and you're going to recover that loss, then we are saying it becomes a non-allowable deduction because they are already going to compensate you. The next item is tax. Tax. You're going to see taxes, for example, withholding tax paid. You're going to see, for example, VAT paid. They are going to tell you went through an audit and this was the tax liability and you have claimed it. Because business is for them when they incur, URA has charged you tax, you want to go and claim it as an expense. We do not claim taxes as expenses. So if you see they have included, for example, withholding tax in your expenses, if you see, let me give you an examples that have largely come in. Things like withholding tax being claimed as an expense. Things like VAT being claimed as an expense. Things like provisional tax being claimed as an expense. Of course, the examiner is going to mix them and wants to see whether you know that tax payment of tax is not an expense and you have to add it back. We have, I am going to gift. You have given gifts to your employees. Are they allowable deductions? No. So gifts given to individuals are not allowable deductions. You can't miss fines and penalties. You're not going to miss fines. Just like you had a free mark for depreciation, also pick the free mark for fines and penalties. Whereas, whenever you get any fine or penalty, that is not an allowable deduction. You must add it back. Next is, now there is confusion about the contribution to retirement funds. Whereas here I'm giving NSSF as an example. Retirement funds are many. Some of them are called provident funds. Others are just called retirement funds. But the famous one we know is NSSF. Not so. Within NSSF, the way we calculate it, whereas the employer is the one that writes the check of 15% NSSF, he is not the one incurring the 15%. The employer only incurs 10%. And that is what is going to be allowed to him. The 5% is not his expenditure because it was deducted from the staff. So if they gave you a number, if they say contribution to NSSF and they have stopped there, don't touch that figure. But if they said contribution to NSSF and in the explanation they say this represents 15%, you know they have overclaimed the expense. What do you do? Look for 5% of that expense and add it back. I repeat this because I've seen errors being made. Sometimes they give you just one line, contribution to the retirement fund or contribution to NSSF, and they have given you a figure. The assumption is the accountant has done it right. But if they gave you contribution to NSSF and in brackets they say 15%, you just know that there is a problem. He shouldn't claim 15%, he should only claim 10%. So I want to only disallow 5. Now, the computation of the 5% again is a problem. When you're computing 5% of that expense, you don't just apply 5% on that expense. You get 5 out of 15 times that expense. You get 5 out of 15 times that expense. You'll be getting the 5% that you want to disallow and add back. The next item is life insurance premiums. Every time they pay for your life insurance is not an allowable deduction. All other insurances are allowable. Call it medical insurance, call it workman's compensation, call it any other insurance for the staff. It is an allowable deduction. The only item that is not allowable is life insurance for the staff. Because life insurance is even after you have left employment. That's why we disallow it. The next item is pension, in case it is there. Alimony not common. These two are common. Very, very common. Expenditure above 5 million from a supplier with no TIN. If they give you an expenditure and then the note says this expenditure was from a supplier who did not have a tax identification number, and that expenditure is 5 million, they are indirectly telling you go and add it back. In simple terms, if you incur any expenditure above 5 million and it is with person who has no TIN, whereas you have paid for this expenditure, the taxman does not allow it as an expenditure. He adds it back. And he adds back all the amount. If it was 10 million, do not say 5 is allowed and then the other 5 is not allowed. No. As long as this person has no TIN, even if it was 6 million, we disallow the whole of 6 million because the principle is this person has no TIN and the expenditure is above 5 million. Because I've seen students who want to look for the difference beyond the 5 million. No, that's not how we do it. We disallow the whole expenditure at that point. The next item is expenses that are not supported by an IFRS invoice, yet they are coming from persons who are registered for VAT. These are free marks because the examiner, you ask yourself, by the way, every time the examiner is explaining an item, even if I didn't know how to do it, if you thought that this expense is a legitimate expense, but the examiner is putting a note on it, the examiner is laboring to explain it, he's giving you a hint. If you don't know what to do, you had better add it back. Yes, because sometimes you actually have to see when you're not sure about what to do, at least do something that you think is closer to the answer. So if you, for example, gave me an expense, say for example, rent, but the examiner has labored to write something on rent, what is he trying to say? Because rent is a legitimate expense, not so. So what is the examiner laboring to tell me? Now, if I am not sure, even if I don't know what to do, the most safe thing is add it back, because I'm not sure what the examiner is telling me, but he's telling me something that I must do about it. The next item, I had talked about provisions, any kind of provision, whether it is provision for bad debts, whether it is provision for future expenses, whether it is provision for marriage, whether it is provision for whatever is the provision. A provision is not an actual expense, and therefore add it back. The same applies. The opposite of depreciation is amortization. Depreciation is for tangible assets. Amortization is for intangible assets. Now again, there are 2 marks here. You don't lose. You can only have amortization if you have an intangible asset. So the accountant is going to calculate amortization and put it in the expenses. You come and disallow it. The question is, remember that intangible asset is an asset. And we said all assets have some capital allowances. The only asset that does not have capital allowance is only land. So every time you see an asset, whether tangible or intangible, ask yourself, which allowance does this asset have? Now, an intangible asset also has a capital allowance. So if you see any amortization and they have given you an intangible asset and they have given you the useful life of that intangible asset, you just know that you have to calculate a capital allowance related to that intangible asset. And how do you calculate the capital allowance? You get the capital expenditure or the cost of that intangible asset over the useful life. That is what you're going to take as an allowable deduction under less allowables. So what would you do? If I have an amortization, first of all, I'm adding it back. Not so? But I go ahead and calculate the capital allowance related to that intangible asset and subtract it. So you're doing 2 things: adding back amortization and subtracting the capital allowance for that intangible asset. You don't mind whether it is the same amount or not, because even in accounting, if you remember your I-38, even in accounting, we actually get the capital expenditure divided by the useful life. If this asset has a useful life, if it has no useful life, we test for impairment. Now, assume it is the same, don't mind. You want to earn 2 marks. Add back the amortization that you're picking from the POL, but go ahead and give this intangible asset its capital allowance. I hope you get that. The next item is impairment. Impairment again is a book item, so you have to add it back. Expenses, that is not common. Mining, not common. Now, there is this one item called expenses purely related to rental income. In your line of revenue, in your line of other incomes, if you ever see an item called rental income or income from property, if you're renting out a property, if you're renting out land or building and the examiner has put rental income in your revenue, it will help you earn 2 marks. I repeat, if you're doing actually not only 2 marks, about 4 marks. Listen, if you're doing number 1 and you see that there is rental income, pay particular attention to it because it could earn you more than 4 marks. Where are the 4 marks going to come from? Number 1, that rental income that was included in your revenue or your other incomes is not income that should be taxed with other incomes. So we must remove it. So what would we do? Go to the tax computation and remove that rental income. That is mark number 1. Mark number 2, ask this rental income, are there expenses that were related to this rental income? And the examiner is going to show you that these are expenses related to rental income. What do you do? Add them back. That is mark number 2. Mark number 3, you must now go and do a separate computation for rental tax. I am going to repeat this because it is common and it's like a cap. When you go to the POL and you find in your incomes or in other incomes, you have an item called rental income. You prepare for more than 4 marks. Mark number 1, get that very rental income. Go to the tax computation and remove it under less allowables. Mark number 2, go to your additional information and look for expenses related to rental income. And I'm not talking about rent expense. Rent expense and expenses related to rental income are 2 different things. Rent is when you're a tenant. Expenses related to rental income is when you are a landlord. All together. So we are looking for expenses related to rental income. What do you do? Add them back. After you have done that, go on the site and calculate rental tax. And I'm going to show you how we calculate rental tax before we leave today. So, if you have any other non-allowable deduction, what is the principle you follow? How do you know that this expense is a non-allowable deduction? If you have any expense that was not incurred in the production of income that you're going to tax now, then that expense becomes a non-allowable deduction. If you're convinced in your heart of hearts that this expense was not a business expense, that this expense was not incurred in generation of income, please go ahead and add it back, because that is the general principle. We are done with the expenses. Let's go to the side of less allowables. In the less allowables, ladies and gentlemen, do not pick an item from the POL in form of an expense and bring it under less allowables. Do not pick an item under expenses in the POL and bring it under less allowables. I hope that is loud and clear. Now that we know that in this part we are not looking for expenses that came from the POL, what are those items that you must know or cram that you will actually put under less allowables? Number 1 item is called exempt income. If the examiner tells you that this is exempt income, don't bargain. Go and bring it to the tax computation. But you're bringing it from where? It is coming from the PO. If you're going to bring any income here, I repeat, If you're going to bring any income here, you must be picking it from the PO. If any item is an item of income here, it must be coming from the PO. Okay. So one of the items is exempt income. Another item is rental income. Another item is profit or gain on disposal. Just like the loss. If it is a gain, you subtract it because it was included in incomes. Next, let me first finalize the incomes so that you know you write them and see, when I see this income, I don't even think twice. So exempt income, rental income, profit or loss, rather profit or gain on disposal. The other income is reduction in provision for bad debts. I have seen students ask me, when you create a bad debt, when you create a provision, it is an expense. When you increase a provision, it still remains an expense. But the moment you reduce a provision, it becomes an income for accounting purposes. And therefore, if you find a provision in the other incomes, you just know that was a reduction in provision. They are recognizing it as income, but it is not income. That's why you're subtracting it in the tax computation. The other income that you can't miss is income which has suffered withholding tax as a final tax. That is why I want to fight with you. I want you to remember these incomes and don't make mistakes with them. If you're dealing with a company, the only income that has suffered withholding tax as a final tax is interest on treasury bills and government securities. Nothing more, nothing less. So if you know that the number you're dealing with is a company, the only time you're going to bring income of that nature is when it is interest on treasury bills and government securities. But if you're dealing with an individual, you have more marks to think about. Because an individual earns incomes that are subjected to withholding tax as a final tax. And therefore, if I again find them in the POL, I will come and subtract them. Which are those incomes? Number one, interest on treasury bills and government securities. Again, it is final in the hands of an individual. Number two, interest on fixed deposit accounts from financial institutions. Number three, if you have any dividends. Number four, if you have any commissions for airtime distribution and mobile money services. Those suffer withholding tax as a final tax in the hands of a resident individual. So if you're dealing with the number of an individual, and it's, by the way, I have seen a situation where the examiner asks these numbers. He asks in number one, a company. In the same exam, he asks another question on an individual. In the same question, he asks a question on a partnership. All those questions are income tax questions, but they are in the same exam. Yet the principles are almost the same. So if you find an exam that is like that, I actually do all the three numbers. Because the knowledge that I'm using to actually do number one is the same knowledge I'm going to use to do a number on income tax for an individual, is the same knowledge I'm going to use for partnership, with a few changes. So those incomes, if you find any income in the POL, and it is usually in other incomes, because there is a high possibility that your number one is going to be on a company, the only income that suffers withholding tax in the hands of a company as a final tax is interest on treasury bills and government securities. Any other income, don't touch it. Okay. Now, other than the incomes in the less allowables, we also recognize the expenditure that the taxman allows, but the accountant has not taken care of. So the only expenses in less allowables that you see there, the only deductions that you will see under less allowables are those expenses, are those deductions that are creatures of the tax law, but the accountant did not remove them in the tax, rather in the POL. And examples are the capital deductions. The examples of capital deductions that we talked about are, for example, the wear and tear, or what you call depreciation allowance. We also talked about industrial building deduction. We also talked about startup costs. We also talked about the allowance related to intangible assets. And then when we come to farming, we talk about the capital allowances that are coming from horticultural plants or greenhouse, or yes, horticultural plant or greenhouse. So those are the capital allowances your antenna should rise up to. Those are capital deductions. You go calculate them on the site, but after you have calculated them, bring them in the tax computation under less allowables. If you calculate them on the side and don't carry them, that is your problem. Because I've seen students, they go and do the working, but they don't know what to carry to the tax computation, or they don't know where to carry it in the tax computation. The moment you go and draw the wear and tear schedule, don't forget to carry the depreciation allowance to the tax computation. The moment you calculate IBD, don't leave it there, go and bring it to the tax computation. The moment you calculate allowance on intangible assets, bring it to the tax computation under less allowables. The other items, I think those are the items. Now, there's one that is also common called minor capital equipment. A minor capital equipment is simply a capital asset, but whose cost base, whose value is less than 1 million. I'll give you an example. Those shares that you seated on, each one is less than 1 million. So if I incurred 10 billion to buy all those shares, even the 10 billion will be a minor capital. Hello? If each of the shares was less than 1 million, assume each of the shares is 700,000, but all the shares combined, I incurred 10 billion. That 10 billion, you're not going to capitalize it for purposes of taxation. You will capitalize it for purposes of your accounting. And the shares, the furniture will be in your balance sheet. But the taxman wants to give you an outright deduction called minor capital equipment. So all that 10 billion will be brought under the allowables at once. You're not going to take those assets in the wear and tear. But if the value was more than 1 million, then you take them to the wear and tear schedule. But because the value is less than 1 million, you are taking them as minor capital equipment, and the whole cost is an allowable deduction. I hope you fixed that. Okay. Finally, you have your totals, and then you get the profit or loss before tax. You add back non-allowables, you subtract allowables, and you have chargeable income. After chargeable income, the other free mark is a carry forward loss. After the carry forward loss, you get your adjusted chargeable income. You apply either 30% if it is a company. If it is an individual, you go to the individual rates. I'm going to come back. Rates, and then you get your tax payable. If this company or if this entity is actually employing persons with disabilities, you calculate 2% of that tax and also give it as a deduction. In other words, that 2% reduces on the tax liability before you can remove any tax credits. And the tax credits we have is either foreign tax credit, withholding tax credits, provisional tax paid, and then finally you can get your outstanding tax liability. In case you get this chargeable income as a loss, you're not going to calculate tax, but you go ahead and remove carry forward loss. You go ahead and remove the tax credits, so that at the end of the day, this outstanding tax liability becomes a bigger negative. Not so. So you don't calculate the tax, but you remove all the carry forward loss, you remove all the credits, so that at the end of the day, if the chargeable income was a small negative, at the end of the day, you're going to have a bigger negative as your final figure. Now, there was a question behind. I want to pick the questions afterwards. I have about another 10 minutes to actually talk about number one before we actually get to the other numbers, because number one is the comparison. Now, we said we have been talking about the wear and tear. Now, whereas the wear and tear is you're only picking one item, the wear and tear schedule usually gives you about more than 4 marks. So it is important for you to know how the wear and tear schedule works and where you're going to place certain assets. You need to know where you're going to place certain assets. And I'm going to show you, we'll run through how these assets are. Now, first of all, we recognize that there are only 3 classes. So this is how your wear and tear schedule is going to be. Again, you have how many columns? 1, 2, 3, 4, 5 columns. You have 5 columns. Column number 1 is for the description of the items they have given you. Column number 2 is class 1 at 40%. Column number 3 is class 2 at 30%. Column number 3 is class 3 at 20%. And then you have the total from class 1 up to class 3. Now, even if you were sleeping, you should be able to get the opening balances correct, because the examiner has given you this opening balance that we are calling the tax written down value balance brought down. This is what we are seeing in our question, where they are giving you classes and they are telling you how much is under each class. That is the opening. So tell yourself that in the way and tear schedule, I must pass the opening balance. If you forget anything else, at least pass the opening balances, because they are free. Number 2 is that you're going to have a heading called additions. And addition simply means the assets they have given you as additions. Your role is to know in which class you place these additions. So let's say examples. In class 1 is extremely restricted. It is computers, and computers mean laptop and desktops. Someone was asking, is a desktop a computer? Yes, it is. It is a computer. You guys, when you're teaching, you learn to be as basic as you can. So here we are talking about whether desktops, whether laptops, those are computers. Now, when they say data handling equipment, they are not talking about your phones. They are not talking about your printers. They are not talking about your cameras. They are not talking about your ATMs. They are not talking about anything else that you think is a computer. Because we have so many things that we think are computers, but they are not computers for purposes of this class, class 1. So we are talking about servers. We are talking about servers. So anything that is not a computer and it is not a server is not going to be in class 1. So anything else that you thought was a computer, please place it in class 3. Anything else that you thought was a computer, please place it in class 3. Class 2 is also restricted. And how will you know that you're likely to have assets in class 2? You first start with what the examiner has given you. If the examiner gives you that note of classes and you see an items in class 2, your antenna should also remember that now that the examiner has given me opening balances, there is a likelihood also that in additions, I'm likely to have assets in class 2. When the examiner gives you nothing in class 1, then you'll be mad in one way or the other to think that there are assets that are likely to be in class 2. Because already the examiner has told you, I have no opening balances in class 2. So the highest possibility is, also in the additions, I'm not likely to have assets in class 2. But all you have to remember, you will only think about class 2 if the number you're dealing with, the person is in either of the 3 sectors: manufacturing, mining, or farming. And we are only talking about plant and machinery. So if they tell you there is plant and machinery, machinery means equipment, machinery, the manufacturer, the factory equipment, the things that are used, for example, in the factory, that is plant and machinery. That's when you put them under class 2. If it is not the case, all other assets go to class 3. So we see, for example, you have computers and data handling equipment in class 1. We have plant and machinery used in farming, manufacturing, and mining in class 2. And then all other assets are in class 3. What are some of those assets? Buses, minibuses, goods vehicles, construction and earth moving equipment, specialized trucks, tractors, trailers and trailer mounted containers, rail cars, locomotives, aircrafts, specialized office and furniture. Now, I want you to see this last item called under 19. I am putting there items of farm works. So if you're doing a number on persons who are in farming, they are likely to have farm works. And I told you the common example of farm works is called labor quarters. They will come in the wear and tear schedule and put them under class 3. Now, these are some of the examples that have come over time in your exams. For example, 10-ton truck, class 3. Buses, class 3. Printing machine, class 3. Generators, class 3. Elevators, class 3. Promotional trucks, class 3. Distribution vans, class 3. Computer printing place, the computer has now come through. This is class 1. Professional cameras, class 3. Office and furniture and fittings, class 3. Computers and printers. Here they are combining them. They are combining computers and it's because the examiner has picked it as computers and printers, meaning this person has, for example, a printer that has one combined computers and printers. But if they separated them, printers would be in class 3 and computers would be in class 1. The reason why I put them in class, because the examiner at that point combined computers and printers. So don't get confused. Rondel soap making machine. Now, Rondel soap making machine. This person is now manufacturing. That's an equipment that would be under class 2. Soap mixer, class 2. Conveyor machines, class 2. 32-ton diesel forklift, class 3. Delivery trucks, class. There is this one item that you must remember. They are going to give you certain wagon cars, certain private vehicles, the vehicles that we sit in, the vehicles that carry less than 13 passengers. These that we call private vehicles, whatever name we want to call them, the Land Cruisers, the Benzes, etc. When you see such a vehicle, you know they are testing one concept called the roads vehicle. A roads vehicle. Now, if we find such a vehicle, such vehicles are restricted to 60 million. So they have purchased a Mercedes-Benz, they have purchased a Land Cruiser, they have purchased a Pajero, they have purchased for the MD for whatever it is. If that cost of that vehicle is beyond is beyond 60 million, in the wear and tear schedule, you're only going to put there only 60 million. And if in that exam they have not told you that that very vehicle was disposed of, don't bother doing anything else. You only pick your 60 million, press it in the wear and tear schedule. The balance, leave it as is. And unless the examiner tells you that this very vehicle which you have has now been disposed of, that's when you're going to be thinking about the other part of the asset that you put aside. Because that other part of the asset that you put aside is called a business asset, where you're now required to calculate capital gains on it because it has been disposed of. So I'll come back to that. Studio furniture, class 3. Billboards, class 3. Self-loader crane, class 3. Display racks, class 3. Compressor, class 3. Industrial mixer, class 2. Mattress making machines, class 2. Toyota Jeep, again a road vehicle. Toyota Kuruga, a road vehicle. Forklift, class 3. Computer servers, class 1. CCTV cameras, class 3. Mobile phones, class 3. I brought these examples for purpose because these are the examples that the examiner has kept on bringing into your exam. So if you don't go through this and remember them, then definitely that will be your problem. Desktop computers and laptops, class 1. Boardroom table, class 3. Pickup trucks, class 3. Lorry, class 3. Trailer mounted, class 3. Trailers, etc. fixtures and fittings. Galvanizing machine, class 2. Saloon cars, again you're talking about road vehicle if it is above 60 million. Manufacturing equipment, definitely class 2. Plant and machinery used in farming, class 2. Expansion of, this one again, labor quarters is class 3. Extension of water drainage channels, class 3, because these are also farm works. The fences, the dips, the water channels, the electricity channels, all those are farm works. But the common one is labor quarters. All that is in the class 3. I told you the one that does not come in wear and tear is called farm houses. Farm houses are not part of the farm works. Quickly, coffee sorters, coffee processors, all those are manufacturing. Water supply works, again, farm works. Tractors, now, if they tell you the tractors are used in farming, manufacturing, and mining, because the examiner is going to be clear for you, you'll actually know where to put it. Juice crushers, agriculture sprayers, land cruisers, bullion vans, class 3 as is. So you go through that and be able to actually know where to place it. But now you have seen that if you actually have your wear and tear schedule, you start with the opening balance, you get to additions. After getting the additions, you must first of all subtract any disposals. If they tell you they have disposed of an asset, you dispose it off from the right class, because the intention is to be able to get to the net assets. How do you get the net assets? Opening balance plus additions minus disposals. You get your net assets. From the net assets, that's when you start applying the percentages. The net assets under class 1 apply 40%. The net assets under class 2 apply 30%. The net assets under class 3 apply 20%. And you'll be getting what we call depreciation allowance. The total of this depreciation allowance is what you're taking to the tax computation. And then you can get your closing balances. Your closing balances here will be the net assets minus depreciation allowance. And you'll be good to go with the wear and tear schedule. You're not going to get 1 mark from the wear and tear schedule. The minimum you get from the wear and tear schedule is about 3 marks. So it's very important for you to actually do it right. Finally, under number 1 is IBD. I don't know talked about IBD, but I need to emphasize. We only calculate IBD on buildings. So you must be convinced that this is a building. Now, any building they give you, if it is an old building, because they'll give you a building and say it was constructed long time, before the year that they are asking you. If you're saying, for example, the year is ended 30th June 2024. By the way, your exam is either going to be 30th June 2024 or 31st December 2024. Your exam is either going to be 30th June 2024 or 31st December 2024. 24. Yes. It's either going to be 30th June 2024 or 31st December 2024. Because we are in 2025, not the years that have already ended, either ended on 30th June 2024 or 31st December 2024. They cannot ask you June 2025 because we are not yet there. So they will ask you either December 2024 or 30th June 2024. Now, when you get a building which was constructed long time before the year they have given you, you don't have any business with apportioning the 5%. Your calculation of IBD is going to be 5% times the qualifying cost times 365 over 365 is as good as multiplying by 1. Because you're saying the old building was there even in this year, it has been used for 12 months. So you have no business apportioning the IBD. But for purposes of the formula, you will get the 5% times the qualifying cost times 365 over 365. It means the only asset where you're going to count the number of days is the asset that was put to use in that year that you're dealing with. If I am dealing with an exam that ends 30th June 2024, when did it start? It started 1st of July 2023, not so. Now, if the building I'm talking about was put to use from 1st of July 2023 to 30th June 2024, assume it was put to use on the very first day when that year of income was starting, it means that building has been used 365 days. But if this building was put to use in the middle of the year that you're dealing with, ladies and gentlemen, you must count your fingers. And you're not counting the number of months. You're counting the number of days. So you count the number of days from the time it was put to use up to the year end. If it was put to use, if the year started in July, 1st of July, and it was put to use in September, ask how many days was this asset used? You'll be counting September, October, November, December, January, February, March, April, May, and June. But in terms of days, so by the time you get into the exam, you must know which month have 31 and which month have 30. And for February, it doesn't matter whether you're taking 29 or 28. That small error is not going to make your answer wrong. Those who don't know, you count we used to count this. If you start from here, if you start from January, you know that is 31. If you get inside, you know that is 30. So every time you rise up, you know that is 31. Yes, you must know how to calculate those months. Because we want you to calculate the number of days. Are we together? Does any one of you have a problem calculating IBD? Because it is the easiest. You have to know. Please don't be confused by the issue of initial allowance. You're not going to have it. Do not be confused by the issue of initial allowance. They removed the initial allowance effective 1st of July 2023. So they're not going to examine you on a question that it goes back to 2023. When we are examining tax, we examine based on the current provision of the law. Initial allowance was scrapped from the law effective 1st July 2023. So you're not going to do an exam that goes back to July 2023. So don't confuse yourself with initial allowance. And even if they told you the asset was constructed long time, you're not going to calculate initial allowance for that. It is not your role. You calculate based on the cost that they have given you, the qualifying cost. Do not first say, this asset was constructed that time. Can't I first give it initial allowance? Don't go there. Don't go Don't go there. You will get it wrong. By the time they give you the qualifying cost, it is the cost upon which you're going to apply your 5%. The only change you're going to do is on new buildings where you have to do the time apportionment. I hope I'm clear. Okay. So an example, for example, if I gave you an example of a building whose cost, assume it is a factory, and its cost was, say, for example, 1 billion, and it was put to use. Now, differentiate between when it was completed and when it was put to. We look for the date when it was put to use. When it was put, so building like this, its cost was 1 billion, but it was put to use on 1st of August 2020. And I am looking at the year that ends 2021, for example. Of course, now you're going to be talking about the current period. You must know the number of days it has been in use. And then you're going to use the 5% because it is 5% times the qualifying cost, which is 1 billion, times the number of days it has been in use, over 365 days for you to be able to get your IBD. Okay, now what should you remember about IBD? For us, say a building is an industrial building. It is either used in manufacturing operations, research and development into improved or commercial buildings, mining operations, an approved hotel business, an approved hospital, approved commercial building. Now, there are warnings that you must remember. If they give you a building, for example, that is used for residential accommodation, if they tell you this building is an apartment, if they tell you this building is used for residential accommodation, please don't bother calculating IBD. But if it is a factory, if it is an office, if it is a commercial building here in town, you will calculate IBD. The only time you're not going to calculate IBD is when they tell you this building is used for residential accommodation, such as apartments. Whereas you incur cost on the apartments, you do not get any capital deductions on those apartments. Okay. So, ladies and gentlemen, that is your number one. You're going to stretch, or you're going to ask questions in the next 10 minutes. I'll give you a break, and then we'll come back and attack another number. That is your number one. Any other nitty-gritties in your number one, definitely you should also add them for yourself. Or between now and before you get to the exam, you can ask as many questions as you, because it is impossible that I'm going to look at everything. But I'm trying to tell you that if you followed what I have said, definitely you must get a minimum of the 50%. And then the other nitty-gritties are for those ones who are looking for 80%. Those who are looking for my 1 million. Of course, the risk is on you and also on me. Imagine all of you got 80% and I have to part with 1 million for each of you. That will be very draining. But I pray that all of you get 80%. I would rather go to the bank and borrow to reward you with your 1 million, but you've gotten your 1 million. So I'm going to get your questions. I am only going to have a few questions. Definitely, we have to attack about 5-6 numbers. So we have to make sure that we reduce the number of questions. I can answer these questions after the session, but at least let me first take you through the session. Okay? Do you want first stretch up? I am actually going to, I think, we will entertain the questions afterwards. I first cover what I have to cover, and then because I can always answer these questions as and when they come. Otherwise, if we are going to answer all the questions at first, definitely it will be very hard. Any question that has come through the chat, I am going to respond to that question, but let's first finish. So keep putting your questions in the chat, and I'll answer all of them. Thank you. We are going to stretch for only 5 minutes and come back. If you want to pick something to eat, go down to the canteen, pick it, and come back. Today is going to be marathon. We are only going to have 1 hour for lunch and come back. But for now, you have 10 minutes. Pick what you want to pick as your break. Come back here. We're going to have a working breakfast. So pick your breakfast, come and have it here, and then we run again up to lunch break. We run up to 1, have 1 lunch break from 1 to 2, and come back. Okay, so shall we come back? Please confirm that your neighbors are back. The 10 minutes are done. We say today we don't have a lot of time, so you forgive me. I'm going to ride you on a marathon. If we are going to sleep here, we're going to sleep here, but I must finish what I'm supposed to finish. And so those of you who are patient, are impatient, you're likely to be patient today. If you feel you want to stand up, you can stand up. All these corners are available for you. But don't doze. If you doze for another 4 months. You come back. That is how painful it is. In a session like this, you doze. If you're not sure, you come back. I don't want you to come back. I want all of you to pass. For me, I have no problem receiving the money as you bring it. But I want you to get out and get to the next papers. But if you don't make it and come back, you have given me more money. But is that what I want? No. I want every one of you to pass. Okay, so guys online, please confirm if someone is asking which paper. There's no specific paper here. I want you to look at your question bank and get any employment income number. Get any number of employment. Get any number of employment. Look at your question bank and make sure you get a number on employment. The ones that have no question bank, why are you looking? You can't be here and you don't have a question bank. That is an abomination, by the way, in a class like this. Because you're committing suicide. You're committing. We are going to discuss employment income for the next 1 hour. Employment income for the next 1 hour. So, a number of employment, this is how it is examined. Again, with employment, they are going to either ask you to calculate someone's chargeable income and tax liability either for a month or for a year. Most of the times, they actually want you to calculate the chargeable income and tax liability for a year. That means 12 months. But sometimes, with employment income, they can ask calculate the chargeable income and tax liability for a month. So as you look at the question, ask yourself, am I calculating the liability for a year? Am I calculating the liability for a month? Because we all know that whatever we earn at our workplaces, we normally earn it on a monthly basis. So anything that they actually give you on a monthly basis, if the examiner is asking you for annual, it means you'll be multiplying by. If you don't multiply by 12 yet, they have asked you for annual. You'll be calculating a number on a monthly basis, yet the examiner wants to calculate on. And do you see how you get 0? I am pointing out the killers. And most of the time, students fail not because they don't know, but because they have not read the question properly. And I want to warn you now. In this question of employment income, the question can either be annual or monthly. So if they say calculate the chargeable income and tax payable for the month of, you know that you're dealing with only 1 month. If they tell you calculate or determine someone's annual tax liability, chargeable income and tax liability, then you know you're dealing with a year. But you are aware that some of the things are paid on a monthly basis. So whatever is paid on a monthly basis, you multiply by. Again, when you go to the schedules, when you go to the tax schedules, for every exam, I want you to see this schedule. For every exam, at the end of the exam paper, you have the rates. you have what you call rates of tax for resident individuals and rates of tax for non-resident individuals. Now, these rates are the ones that we use for individuals, whether it is income tax, whether it is partnership, whether it is employment income. I repeat, these schedules help us to determine tax on numbers of income tax for individuals, on numbers of employment for individuals. Of course, companies don't get employed, so employment is basically individuals. And also on numbers of partnership, because we say in partnerships, the tax is on individuals, not so. So we use the same rates. All you need is to know someone's chargeable income, and then after knowing chargeable income, know where to apply the rates. Now, I want you to see these rates. Some of them are in brackets, others are not in brackets. The figures that are not in brackets are annual figures. The ones that are in brackets are monthly rates. That's why they say, for example, 2,820,000. That is the threshold for a year. But if you want to know that threshold on a monthly basis, is 235,000 per month. So PM means per month. I do not want you to fail calculating the tax when the answer is in the exam. They've given you the rates and you're stuck on how you calculate. So before you get into the exam, you must know how to apply these rates. The other thing in this exam, the other rates they give you are for presumptive tax, the small business taxpayers. So always remember that. Now, when it comes to employment income, there are certain things that you must know. They are basically about 4 things. About 4 things. Now, the question is saying, determine VIN's annual tax liability for the year ending 31st December 2022. It simply means they want you to calculate the annual tax. So whatever benefits, whatever allowances that have been paid on a monthly basis, you must multiply by 12. Number 2 is that in employment income, you're only looking for 2 things. Whatever they have paid you, it is either in cash form as an allowance or it is in kind. They have given you certain privileges. They have given you certain items. They are treating you different from how they treat other employees. They are giving you certain privileges. Whereas they have not given you money, but they are giving you certain privileges. Those privileges are taxable to you as the one who has received them. So you're looking for 2 things. The things that have been given to an employee in terms of money and in terms of kind and are taxable. Those are the ones that are going to result into tax. But there are also other items that are going to be given to an employee which are exempt from tax. But the examiner wants to see that you know that this item is exempt. So every item that they have given you, for example, in this question, they have given you about 9 or 10 items. The examiner wants to see that in your answer. But as he sees it in your answer, it does not mean that everything is going to be taxable. So if you know that an item is not taxable, can you imagine how sometimes examiners cheat for you? They give you one part for calculation, and the other theory part, they say, these items that are exempt from employment income. So anyone who has passed the calculation cannot pass that part, because the items that you actually put as exempt are the same items they want you to put in the list of items that are exempt. So whatever is in here, they are going to describe for you an employee or an individual who is in employment. This person is either going to be a Ugandan, that's what you want to hear. Because when I say resident or non-resident, sometimes you get confused. If this person is not a Ugandan, then they have actually picked this person outside Uganda. We call such persons expatriates, not so. Now, these persons, because they are not Ugandans per se, they come as non-residents. It is only when they have been here for a minimum of 6 months that they become residents. So if someone has come as an expatriate and you're calculating tax for 1 month, for example, the time when he has come, it means you're going to use non-resident rates. You saw the rates that we saw in the tax computation. Because at that point, it's still a non. For you, if you don't have a permanent home in Uganda, we are looking at your presence in Uganda. And if you have not been present here for at least 183 days, 183 days is 6 months and 1 day, you still remain a non-resident. But if you're doing a number of 12 months, don't bother yourself of whether this person is resident or non-resident. Automatically, he is resident. So apply the resident rates. Are we together? Good. Now, the other thing that you have to remember is that they are going to describe for you this employee. If he has come from outside, it is the employer's obligation to incur costs of relocating this person when he is coming to Uganda. And when he is finally leaving Uganda after the employment term has ended. So the cost of shifting him from wherever you're picking him and his family to Uganda, whereas the employer has incurred it, you can't charge it on the employee. It becomes exempt income. It's not going to be taxed. What you call relocation cost. The technical word is called passage cost. These are relocation costs that an employer incurs to bring someone from their country to Uganda. Because if you employ someone, for example, from Netherlands, they are going to come with their family. So if you incur tickets on them, if you incur any cost to relocate them to Uganda, that is not taxed on them because it is your obligation as an employer to bring them to Uganda. And finally, when they are done with the contract and you transport them back, again, you cannot charge an employee for such a payment. But if they went for their holidays within the contract and you're the one meeting their costs of going for those holidays, you charge them tax because it is a benefit to them. The reason why I've talked about expatriates is that is a free mark, because the moment you see the one who is being employed is an expatriate, then you know the examiner is likely to ask you about relocation, cost of passage, costs. Now, as you get into that number, remember we are looking for two things. Is the item being advanced to the employee, whether in monetary terms or in kind, is it taxable or not? You must make that decision. I read an item, this was given to the employee. Is it in cash? If yes, is it taxable or not taxable? Is it an item? Is it something in kind? Is it taxable or not taxable? Everything that is taxable, you must determine the amount of the taxable amount that you're going to tax. Anything that is exempt, you put 0. I do not want a situation where I've said an item is exempt, but when it comes to the column of amount, you're again putting the amount and then aggregating it with the chargeable income. You're contradicting yourself because you've said an item is exempt. It means you're not going to tax that item. So in the column of amount, you must put 0. So that at the end of the day, you're only aggregating items that are taxable to become the amount that has entered this person's chargeable income. The employee only has one allowable deduction. An employee only has one allowable. So you get all his taxable income and remove only one item called local service tax. If he paid local service tax, and then what remains becomes his chargeable income that you're now going to the schedules to see the tax. So this is how it's going to be. I hope my screen for the Excel sheet is seen again. So forget about this column of notes. all you need to do is organize your answer like this. I hope you can see the board. They are going to describe for you the items, and for you have to list what the item is and make a decision whether it is taxable or not taxable. If it is taxable, put the amount in the column for amount, because that is what you need to aggregate at the end of the day. So we have items that are going to be taxable and items that are going to be exempt or not taxable. Now, this question can answer two questions for you. Because I've seen the examiner asking part 1, compute the liability. Part 2, identify incomes, employment incomes that are not taxed or that are exempt from tax. So anyone who has picked this ends up answering both parts. Now, there are only about 8 items that when received by the employee is not going to be taxed. Any other items that come to the employee, it will be taxed. So we're going to look at these 8 items so that when you see it, you automatically know that this cannot be taxed on the employee. Now, when you have aggregated, do you see, when I say it is non-taxable or it is exempt, I put 0 in the column of amounts. When I say it is taxable, I put the amount that I have taxed that I have calculated that is going to be taxed. And then I am able to get my total employment income that is taxable. It is only on that employment income that I less any allowable deductions, and I've said the employee only has one allowable deduction, which is local service tax. And then I get the chargeable employment income. When I've got this, I am done with my number. All I have to do is get this chargeable income and go to the other schedule and pick the tax. That is how easy employment income is. So let's go to the items now that they are going to examine you on, so that when you see it, you automatically know that it is taxable. Because when you aggregate your total and your employment income is wrong, automatically whatever follows is going to be wrong. But don't mind, because we mark item by item. So do not mind about the charge, because there are not very many people that will get everything right. By getting everything right, that's when you get your chargeable income right, and then you can attach the liability, rather the tax. So do not focus so much on the chargeable income, but focus so much on the items. So let's look at the items. Now, whatever name they call them, they will never change the naming. So when you see these items, automatically take them as taxable items. Number 1, wages, salaries, leave pay, payment in lieu of leave. Payment in lieu of leave simply means you are meant to take leave, but they did not give you your leave. Instead, they gave you money as compensation for not taking your leave. It is chargeable to you. Overtime, someone was asking, is overtime pay taxable? Yes, it is taxable. Fees for work done. Sometimes, instead of describing it as a wage, sometimes they call it fees, commissions, etc. This is not school fees. It is for work done. You are an employee, for example, they say, we are going to be paying you some fee for what you have done. So do not confuse it with school fees. Commission, especially marketeers. Marketeers, they will tell you, this is your best pay, but every time you hit this milestone, we'll give you an additional commission. That also becomes part of your taxable income. The next one is gratuity. Ladies and gentlemen, there is a difference between gratuity and pension. People normally confuse the two. Gratuity and pension are different, and they are also different from terminal benefits. So don't confuse these 3 things. Terminal benefits, gratuity, and pension. Among the 3, it is only pension that is not taxable, but all others are taxable. Gratuity is taxable, and terminal benefits are also taxable. Bonus, if they give you any bonus, it is taxable. Travel allowance, now I want you to be careful here. Sometimes you find you're actually going on your own business. The MD is going for a holiday and they have given him a travel allowance. That becomes taxable to him. But if this same employee is going to the field, is going for a business workshop, the MD has gone to maybe Dubai for a business workshop, that travel allowance is not his benefit because he's working for the entity, he's working for the company. If you went to the field, definitely you're expected to be facilitated. So that travel allowance they give you is not taxable on you. But if they give you any other travel for your personal affairs, then that is what we are talking about. Entertainment allowance. There are guys that are actually big in entities. They give them entertainment allowance. They know because you're big, you're like to actually be meeting people, and you're an MD. They know you hang out at Serena, and every time you hang out at Serena, probably you have friends, and from friends, that's where you actually have engagements. That is not a business expense because even when he has not had the engagements, he will still eat that money. So that entertainment allowance is taxable on this person. Now, allowances for utilities. Utilities are things that you use at home. You're an employee because you're a manager, because you're an MD, and they're paying everything for you. Or they are giving you allowances for utilities. They know you incur water bills, they know you incur electricity bills, they know you incur wastage, rather garbage collection. And they say in a month, this MD could actually be incurring about 1 million shillings. So they give you an allowance for utility bills. Again, that is taxable on you. Allowances for cost of living, covering cost of living. Whatever cost of living it is, as long as they are giving you that allowance to cover your cost of living. You guys, you have not seen organizations, the organizations that have over like 30 benefits to employees. Now, some of you are being employed where you only have your salary. You always think that it is only salary that is taxable. And that's why, by the way, this employment, most of the students fail because of the experience they have. Now, some students fail because of the wrong things they are doing at work. Guys, listen. Most of the students fail because they want to bring the practice to the exam. They have been giving you certain allowances. They have been giving you accommodations. They have been giving you transport to go back home. And they have not taxed you. So in your mind, you're like, it is not taxable. But it is the company doing it wrong. So I want you to get out of your normal operations. We know the wrong things you do out there. So don't think about your company, think about the exam, and whatever I've said is taxable is taxable. And you can deal with your company later. Now, the next item is housing allowance. Housing allowance. Now, there is a difference between the employer giving you an allowance. Allowance means money. Or the employer renting for you a house. Or the employer giving you a house. Those are three different things. When they give you a housing allowance or accommodation allowance, that whole money is taxable as it is. Because they are giving it to you in cash. When they give you a house, or when they are paying rent for you, then we look for what we call an accommodation or housing benefit. And the formula is going to be the same. So differentiate. Have they given me the money? That is the housing allowance, all of it's tax. Are they giving me a house or they are paying for me rent? If they have given you a house or paying for you rent, we look for what we call a housing benefit. I hope you go with the difference. The next one is medical allowance. Again, there are also things that confuse students on medical. There are basically three things. and it is only one that is taxed among the three. For medical, we either give you an allowance, whether you're sick or not. We say part of the benefits is that we are going to give you 1 million medical allowance. So every month you're short of the 1 million, whether you're sick or not. That money is whole taxable. Another way is when we get an insurance company and we give you an insurance for yourself and your family. That insurance is not taxable. It is a benefit, yes, but it is a benefit that is not taxable. Number 3 is when you are sick, you go to the hospital and incur hospital expenses or medical expenses, and it is the company paying for those expenses or refunding or reimbursing the medical expense that you incurred. Again, that is not taxable. So the only time we tax you is when we give you a medical allowance. I hope that is also clear. Next, any other allowance. Now, you companies have so many names of allowances. The other time a student was telling me, for me, they pay me what we call cash handling allowance. Yes, cash handling allowance. That is an allowance. So every time they give you any allowance, you just know that it is taxable unless it falls under the 8 things that we are going to discuss. If they have given you any allowance, whether it is hardship allowance, they have transferred you now to Kabonga and they are giving you some allowance, that is still taxable. So cram it that every allowance given to you is going to be taxable unless it falls in the 8 things that we are going to see, which we are calling exempt income. Now, the things that we have seen are allowances or things that are payable in cash. Are they the only things that are taxable on the employee? No. We also have things that we call payments in kind. Now, payments in kind is that they give you certain privileges. They give you certain items, but those items result into taxable benefits. So you must know, if they have given me a certain privilege, how do I get the benefit out of it? How do I calculate the taxable benefit out of it? Now, the privileges that you see are listed here. Number 1 privilege, which you're not likely to miss in case you're doing an employment number, is motor vehicle benefit. So how do you know that an employee has a motor vehicle benefit? They will describe this employee as having been given a motor vehicle. The moment they say this employee has been given a motor vehicle, if the examiner does not go ahead and say it is strictly for official work, then you know that there is a motor vehicle benefit. Even if they tell you it is used for both official and private purposes, there is a benefit. It is only when the examiner has said that this motor vehicle is only for official purposes. If he is silent, please calculate the motor vehicle benefit. In simple terms, when this motor vehicle is available for the employee, and this employee can take it home, you drive it home, bring it back home to work. Even if the whole day you were using it for official work, we still say that motor vehicle is available for private use. It is that private use that we are taxing you on, that we are going to calculate motor vehicle benefit. So do not enter that exam when you don't know the formula for calculating motor vehicle benefit. And I'm going to illustrate it shortly. The other benefit is when they have given you provision of a housekeeper. A housekeeper can be named anything. A maid, a shamba boy, a gatekeeper, a security guard, whatever it is. And we are going to see the only housekeeper that is exempt from being taxed is a security guard. Is a security guard. All other house helpers, if it is the company paying them for you, you have a benefit that is taxable on you. And we're going to see how do you get that benefit as a taxable benefit. The next one is a chauffeur. A chauffeur is the same as a driver. Now I want you to imagine and how you earn your marks. Assume they have given you a vehicle, they are fueling that vehicle, they have given you a fuel card, and they have also given you a driver. You have three benefits. You have a benefit for the motor vehicle, which must be calculated. You have the benefit for fuel, and you also have the benefit for the driver. So see how you earn 3 marks in a minute. So a chauffeur is a benefit. Provision of a gardener is a benefit. Other domestic assistance, as long as it is the company paying them on your behalf, then they generate a benefit for you, and we're going to see how that benefit comes. Provision of any meal, refreshments, so provision of any meals, refreshments, or entertainment not on equal term basis. The common one is some employees on a Friday, for example, they give them certain things. You work with Uganda breweries, on a Friday they give you a crate of beer to go and enjoy. You guys, you need to get some of these employments. You work with MTN, on a weekly basis, for example, they give you like a 50,000 for airtime. That is now airtime. But for meals and refreshments, some security firms on Friday, they give you food. Now, the only time it does not, when they give you meals or refreshments, the only time it does not get taxed is when they are giving you these meals on 2 occasions. Number 1, they are providing these meals and refreshments to all full-time employees on equal term basis. And we're not talking about them giving you cash. The moment they give you cash, it becomes taxable. The moment they give you meals in your premises, or premises operated on your behalf, on the behalf of the employer, and these meals are available to all employees on full-time basis, that's when it becomes non-taxable. Again, if you're giving meals to your staff, but you're giving meals on different values, the MD eats food of 100,000, the other staff eats food of 50,000, it becomes taxable. The other count when the meals don't get taxed is when they have given you meals while traveling to perform employment activities. Because when you're going to the field, they give you transport, but they also give you money for meals. So that does not get taxed. But any other meals given to you by your employer will be taxed on you. The other item you should remember is provision of utilities in respect of employees' place of residence. This time they are not giving you the money, because on utilities, if you remember the allowances for utilities, this time, for example, they are paying electricity for you, they are paying national water for you, they are paying garbage collectors for you. That they pay on your behalf is your benefit. Next is, this one is also a must understand. Actually, there are 3 things that require you to understand how to calculate them: motor vehicle benefits, housing benefits, and loan benefits. You can never do an employment number without at least one of those, or even all of them. So the other benefit is called a loan benefit. So I'm going to help you calculate the motor vehicle benefit, the housing benefit, and also the loan benefit. But every time you see an employee paying advanced money, which is not their salary, they are either giving you money in advance or they are giving you a loan, then we must look for what we call a loan benefit. And we're going to see how that is calculated. The next one is waiver by an employer of an obligation of an employee to pay or repay employer's debt. The employer has given you a loan, for example, or has given you a salary advance, and he says it's okay. Since you're struggling, don't pay it. They have given you a loan of 10 million and COVID has hit you and say, it's okay, we are going to write off these loans, don't pay them. The taxman sees it as a benefit because you are meant to pay, you did not pay. So that waiver is a benefit. There are also times when the employer has given you physical properties. You have a laptop that you have been using and it remains the property of the company, but at one point they say, please take it for good. You have a vehicle that they have given you for good, for tax. That is a benefit that is taxable on you. I talked about provision of accommodation or housing benefit. This is when they have given you a house or they are paying rent for you. It is taxable. Provision of any other benefit not paying, exempt. And finally, discharge or reimbursement of employee private expenses, not even finally. We still have some other items. So discharge or reimbursement of employee private expenses. I usually use an example. You go to the bar, drink yourself silly, and you're telling people, you know how the men do it. When they do like this, it means what? Another round. So you give people rounds, and by midnight or by around 2, that's when you've lost the mind. They give you a bill and you look at it, it looks at you, and they're saying 3 million. There's a time when we actually went, I think we're about 7 people. By the time we finished, they gave us a bill of 2.5 million. And I'm like, okay, have we eaten gold or something? So that money, if you're stuck, for example, and then you call your employer and the employer says, let me pay it for you. That is a benefit to you because they have discharged your private expenses. Okay. Next one is compensation for termination of any contract of employment. We call this one terminal benefits. You have been working for this employer, and now, for example, who has been working with you? Said, and I say the employees here, you said projects. They can't say now. But sorry, most of the people that have been working with the state projects are losing their jobs. And it's unfortunate. But as they lose their jobs, or for example, the guys who are working with UNRWA, these entities that were merged, most of them lost their jobs. And they paid them terminal benefits. Those terminal benefits are taxable. The only time we give you a benefit is when you have been working with this employer for 10 years or more. So if you have been working for this same employer for 10 years or more, we only tax 75% of that benefit, and the 25 becomes exempt. If, for example, they were giving you 100 million, we tax the 75 million and 25 becomes exempt. Only and only if you have been working for more than 10 years. Now, I want also cheat for you exams. There is this item called life insurance premiums. When you're doing a number on employment, and the first statement the examiner says, this entity is tax exempt. For example, you have a company, like some of the NGOs, some of the charitable organizations, when they have got their tax exemption certificates, they become tax exempt. So a number that you're doing and the examiner says the company is tax exempt, he is only pointing you to one item called life insurance premiums. When your employer is tax exempt, and when we say tax exempt, means exempt for income tax. They are not paying income tax. It means when they pay you or when they pay for you life insurance premiums, we tax it on you, that benefit. But when the employer is tax paying, In other words, when it is a taxable entity, we exempt it in your hands. Do you get the difference? I repeat this. When they say the employer is tax exempt, it is the employee that suffers when they have paid for them life insurance premiums. When they are quiet about whether the entity is exempt or not exempt, you assume it is not exempt, not so. And when it is not exempt, that life insurance premium becomes exempt in the hands of the employee. So it can fall under taxable or exempt. When does it become taxable? When the employer is exempt. When does it become exempt? When the employer is paying his income tax. I hope you've got it. Next, or third last, is payment or consideration for the employee's agreement to any conditions or change in conditions of employment. Now, most of the times we call this hardship allowance. What is the other name you call it? When they send you to hard-rich areas? Which one? Risk allowance or disturbance allowance. Have you heard those names? Risk allowance, disturbance allowance, hardship allowance. We still tax you even when you're going to the hardship place, hard areas. It is an allowance, it is an additional income, so it is taxable. Next is value of shares exceeding consideration paid by an employee in a share acquisition scheme. Now, again, there are 3 marks on this that you must take care of. I think we said I explained it to you. With share acquisition schemes, it simply means the employer has a scheme where he allows employees to be part of the shareholders. So there are 3 things that are examinable under Section 19 on employment income. And mark them. Because 2 of them are taxable and 1 of them is not taxable. What are these? Number 1 is when they have given you shares. You have been a good employee and they have given you shares. But they have given you shares at a price lower than the fair market value of those shares in the company. Assume the company shares are at 500 shillings. But they have given you these shares at 300 shillings. What is the benefit? 200 shillings. So the 200 shillings times the number of shares they have given you is your benefit. Because any other outside will buy them shares at 500. For you, they have given them to you at 300. Meaning the 200 is a benefit times the number of shares. That is 1. Number 2, that is taxable, is that this time they don't give you shares, but rather they give you what we call a share option or right. A share option or right simply means that they are promising to make you a shareholder in the future when you meet certain conditions. But at that point, when they are giving you the share rights or options, they are not giving you actual shares, but they are giving you an instrument called an option or a right. It is an instrument that has a monetary value, and you can transfer it to someone else. Now, when they just give it to you and you have not transferred it to someone else, it is not taxable. So a share option or a right is not taxable. It only becomes taxable when you transfer it to someone else for a gain. So that gain is what we are taxing. So 3 things. They have given you shares at a reduced price. That is taxable benefit. The reduction. Number 2, they have given you a right or an option and you've gone ahead and disposed it off and got a gain. That gain is taxable. Number 3, they have just given you share rights or options, but you haven't done anything about them. That becomes exempt. Got it? Okay. So I've already explained all this. I am now going to go to the exempt items. I'm going to go to the exempt items. There are 8. If you can cram the 8, then you can be sure you get them right. In fact, if I were a student, I cram the 8, and anything outside the 8, I tax it. And these things where we are, when we to say, how many days are we talking about? How many days are we talking about? There are some students who have even started writing formulas, especially for theory areas. You know, mnemonics. When we were studying ACCA, we used to create mnemonics. That you know something has 10 points, but you can't put these 10 points in your head at once. So what you do, you create a formula for them. You create a word out of them. The moment that word comes, you know it's one word, you only have to remember one word. The moment the word comes like this, you remember all the 10 points. Even if you forget, you can't forget more than 3. At least you remember the 7. But when you don't have a formula, definitely you're finished. Okay, so let's look at the 8 items that are not taxable. 8 items that are not taxable. Item number 1 is what I was talking about, the relocation costs. Technically, we call it the cost of passage. But what that means is that we are talking about an expatriate. So every time you see an exam and they're saying they are employing an expatriate, prepare yourself for cost of passage. Sometimes they call it cost of passage. Sometimes they call it relocation costs. Sometimes they only describe what they did. That you know this person was coming from Netherlands and they paid for their tickets and his family to come to Uganda. That is what we are calling passage costs. And please note, passage costs do not include the means costs. You have brought the employee, yet you have met his relocation costs. But this employee is likely to be going back to his home for holidays, and you're likely to be the one meeting the costs. Now, if you meet those costs as he is going back home, it is not part of the passage costs. So those other costs you're going to charge them on him as travel costs. So do not mix. Passage costs means when you're coming for the first time and when you finally go for the last time. These other middle travels, if they pay for your tickets, it is taxed on you. Are we together? Next is reimbursement or discharge of employees' medical expenses, including premium or other amount paid for medical insurance. When they discharge your medical bills, when they reimburse your medical bills, or when they have paid for your medical insurance, we don't tax you. The only time we tax you is when they have given you what? Medical allowance. Next one is, I have already discussed life insurance premiums. The only time when you are going to be exempt is when you have medical insurance allowance premiums other than those by tax exempt employers. So this time, if your employer is tax paying, then if they pay you any or they pay for your life insurance, it is not going to be taxed on you. It is going to be exempt. I had already talked about the subsistence allowances, allowances for accommodation, travel expenses, meals and refreshments while undertaking travel in performing your employment activities. The MD went for a workshop and they paid for his travel. You went to the field, they paid for your travel. They gave you transport, they gave you meals. Definitely that is not taxable on you because it is meant to facilitate your work. Next one is meals or refreshments for full-time employees on equal term basis. If the company gives you food and it is available for everyone, by the way, they don't force everyone to eat. Do not say that everyone must eat. But is it available to all full-time employees on equal term basis? If that is the case, then that becomes non-taxable. The other benefit that is not taxable is a benefit that is less than 10,000 a month. If they gave you airtime of 5,000 per month, that cannot be taxable on you because the benefit is less than. Do not multiply 5,000 by 12 and say, but now it has now become more than 10,000. But was it less than 10,000 per month? If the answer is yes, then it is still non-taxable because per month is non-taxable. Contribution or similar payment by the employer make retirement fund. For example, the 10% they add for you on your NSSF cannot be taxed. And when we talk about retirement fund, by whatever name it is, whether it is provident fund, whether it is called retirement benefit scheme, whether it is called the NSSF, it still remains a retirement fund. So when the employer makes a contribution of that nature, it is not taxable on the employee. I had already talked about the value of rights or option to acquire shares, so I want to repeat that. So I'm now going to go and look at the specific formulas for calculating the benefits in kind. Ladies and gentlemen, for all other items other than housing, loan, and accommodation, the formula is the same. What is the formula? We see what the employer is paying on your behalf minus any contribution that you could have made. If, for example, we are talking about a driver, and the driver, say, for example, is paid 1 million, and the employer contributes 800,000 and you also contributes 200,000. It means it will be, the benefit will be the 1 million that is paid to the driver minus the 200,000 that you contributed, because you're looking for only the benefit coming from the employer. The driver is paid 1 million, but you're the one who contributes 200. So what benefit has the employer given you? Only 800,000. So for any benefit in kind, you look at what the employer has paid minus the employee's contribution, if any. If it is not there, then you look at what the employer is paying on your behalf as a benefit. If they are paying national water for you and the bill is 500,000 per month, you get 500 times 12. Remember, guys, to multiply by 12 if you're dealing with anything that is paid on a monthly basis. The moment they say monthly basis, then you remember to multiply by 12. Okay, so let's look at a few formulas. Number one is going to be on motor vehicle benefits. Motor vehicle benefits, you have to remember the formula because it's not going to be given to you. And I've seen students get confused. If you have been confused, I have seen so many questions running around this. Students confuse the motor vehicle benefits with the motor vehicles under section 27 for purposes of depreciation. And I want to clear the air. This motor vehicle benefit is for employment income purposes. The motor vehicles in section 27 are for business income purposes. The rates in section 27 have no relationship with the rates in section 19. The rates in the wear and tear are only meant for business income and it stops in section 27. Don't mix the rates in the wear and tear and say, I always take this motor vehicle in class 3 and therefore 20%. No. The 20% stops in the wear and there are rules under section 19 on how we calculate motor vehicle benefit. So master this. When we are looking for motor vehicle benefit, number one, you must be aware that this motor vehicle is available for this employee. It is used or available for use. Even if they gave it to you and you parked it at your home, it is available for you. Even if you brought it from home and parked it in the company's parking, it is still available for you. So if they have given you a motor vehicle and you're using it for both official and private purposes, we assume that it is available for you the whole day. And therefore, we'll be looking at 365 days of using it or being available for use. It is only in rare circumstances when the examiner specifically tells you the days when this motor vehicle is not available for private use. So watch out. The examiner will tell you that, say for example, this motor vehicle is parked at the office premises over the weekend, meaning it's not available over the weekend. This employee can use it from Monday to Friday, but over the weekend it's not available. Another example, you could say this employee goes for leave in a month, for example, the month of December. And when he's going for leave, he leaves this car in the office premises, meaning it is not available for him. Or he says this motor vehicle is normally taken for repairs, say for example, one day every month, and it's not available to the employee when it is in the garage. He's always being specific for you to know when this motor vehicle is purely not available. And from the 365 days, you must remove the days when it is not available for use. Now, what is the formula? Like I said, there are formulas that are not in the exam, and therefore you must go with them. I am not saying write them in your thighs. I am saying go with them in your head. Because if you write anything, by the way, ladies are very smart. They used to say ladies would write answers in the thighs, and you would wonder, how then does she turn to actually look into the side to actually see it? Eh? Time. Okay. So 20% times A times B over C, or in brackets minus, you remove the brackets, you get it wrong. It is 20% times A times B over C, close the brackets minus D. Now we must understand what each of the items are. We start with A. This is where students normally get it wrong with A. A, we are actually talking about, in simple terms, we are talking about the net book value of this vehicle. I am trying to break it, I'm trying to bring it to the basics. We are talking about the net book value of this vehicle. Idea, we are talking about the market value of this vehicle at the time when it is first provided to you. I'll give you an example. If I'm an MD, if I'm an employee, and I have been employed, and they have given me, they have bought a vehicle when I have been employed that year, and this vehicle was bought at 200 million, my A becomes 200 million, because that is the value at that point. But if I am the same employee, I used this vehicle last year, and I am using it this year, I must depreciate that 200, because that was the cost of the vehicle then. What is its value now, at the beginning of the year? If I am an employee and there was a former employee who was using the vehicle, the question is, how many years did he use the vehicle? So I must depreciate it up to the time when I first get that vehicle. So if someone else has used it for 2 years, I depreciate it for 2. Even if it is me who has been using it for 2 years, I must also depreciate it for 2. But you depreciate it until the first day of the year that you're dealing with. You don't depreciate it to the end of the year, because you're looking at each year as a fresh year. What is the value of that vehicle at the beginning of the year that you're dealing with? So an example, I am an employee who has been given a motor vehicle, and they have just bought this motor vehicle at 200 million. The value of A would be 200 million. Another example, I'm an employee, but by the time I come, there was another MD who was using that vehicle, and that vehicle had been purchased 1 year back. For me, I'm getting it in the second year. I am going to depreciate that vehicle for one year. I am the same employee. They gave me that vehicle last year. I used it last year. But I am now using it this year, and I'm calculating tax for this year. I again depreciate it for 1 year. How do we depreciate it? We depreciate the cost of the vehicle using reducing balance basis. And the rate of depreciation is 35%. Please listen and listen carefully. The rate of depreciation is 35% on a reducing balance basis. What does that mean, by the way? Reducing balance basis means in the first year, you get the cost times the 35%. That gives you depreciation. But you're looking for the net book value. So you get the cost minus depreciation to get the net book value. If it was the second year, you use the net book value in the first year to apply the 35%. So you keep depreciating the net book value and not the cost. Don't go back to the original cost. You only use the original cost when you're depreciating for the first year. But other subsequent years, you're depreciating the net book value. The shortcut is like this. If you know that you're depreciating that vehicle for 1 year, you get the original cost multiplied by 0.65. If you're depreciating it for only 1 year, I am giving a shortcut. Remember, depreciation is 35%, meaning the net book value is standing at 65%, and that is what you're looking for. So if I am depreciating it for 1 year, I get the original cost multiplied by 0.65. The figure I get is the net book value. If I am depreciating it for 2 years, I get the original cost times 0.65 times 0.65. I have now depreciated it for 2 years. The figure I get is the net book value. I am not like a student who first calculates the depreciation and then gets the cost, remove the depreciation, and then get the net book. You don't have that time. So the shortcut is first know how many years you're depreciating it, and then get the cost, original cost, multiply by 0.65 if it is 1 year, multiply by another 0.65 if it is 2 years, if it is 3 years, multiply by another 0.65. So depending on the number of years you're talking about. And the result you will be getting is the final answer as net book value. Now, what you have got is only A, is not the motor vehicle benefit. Because I've also seen students that after they have done that depreciation, they actually say that is the motor vehicle benefit. You are still calculating only A, because the A is the value of the vehicle. The next one is B. B is only the number of days this vehicle has been used or available for use by the employee. Now, standard is 365. 365. You only reduce that 365 on B if the examiner has been specific and said that this vehicle was not available on a particular date. For example, I want to ask you, if they said that this vehicle is not available over the weekend, this guy parks it on Friday and it's not available over the weekend, how many days in a year is this vehicle not available to the employee? How many days is it not available to the employee? They have told you it's not available over the weekend. And you know you started from 365 days. So how many days is it not available? Huh? How many? Please give me your answers. My question is saying, and you see how you have to face something that you know. Imagine you go to your formula correct, but you are failing to calculate the number of days. The examiner said, this motor vehicle is not available over the weekend. So how many days is it not available? Because You first know the days when it is not available for you to know the days when it is available. Not so. And B is the number of days when it is available. So if they say it is not available over the weekend, how many days is it not available? 104. If you get any other answer, it is wrong. Because it comes from the fact that a year has 52 weeks. And each week has only 2 weekend days. Not so. So if you multiply that, it gives you 104. But is that the B? No. The B is the difference between 365 and 104 when it is not available. Are we together? Is there anyone who is still confused about the B? I hope you got it. The C is constant, so cram it now. The C is 365 days. So you realize that in that formula, the only challenge is A and B. Once you get A and B, you get it right. Because D is if this employee made any contribution to this benefit of the motor vehicle. Sometimes they require you that, for example, every month you're going to contribute 200,000 for the motor vehicle benefit. It means you get 200,000 times 12 to get the D. So the D is the employee's contribution. So the formula is 20%. I open brackets, 20% times A times B over C, close the brackets, minus D. My advice is, every time you have B over C, first get that B over C. So do the division. And then after the division, first get your A. You first subtract your B, you multiply by the B, and then you apply the 20%. Once you finish the one that is in the brackets, is when you remove the D. Do not open the brackets until you have completed the part in B, rather in the bracket. So it means you have 2 percentages that you're likely to deal with. One which is 20% in the formula itself, and then the one that you use to depreciate A. Not so. So don't get confused by the two. Okay, that is motor vehicle benefit. The other one is housing benefit. Housing benefit. The first warning is that housing benefit must be calculated last. Calculate everything else and leave one item called housing benefit. So if you know that the employee has been given a house, if you know that the employee has been given, is being paid rent for, they are paying rent for the employee, he has what you call a housing or accommodation allowance. So how do you then calculate that allowance? No, how do you calculate the benefits rather? You must calculate two things and choose one that is the lesser of the two. You calculate two things and choose the one that is the lesser of the two. So what are the two things? Number one, they say the market rent of accommodation or housing reduced by the payment made by the employee. What does that mean? An example, they are paying for you rent, and each month they are paying 2 million. How much is the annual payment? They are paying for you 2 million. How much is annual? 24 million. What if you're contributing, say for example, the 24, you're contributing 2 million. So it will be 24 minus 2. That becomes your A. If they are giving you a house, they will give you the annual market rent of that house. They will say, whereas we give this employee house, the annual market rent of this house is 24 million. And the employee contributes, say for example, 200,000 per month, meaning he contributes 2.4. So you get 24 minus 2.4. So what the employer is paying for you, if it is per month, multiplied by 12 minus your contribution as an employee. Or what the market value of the house is minus the employee's contribution. That becomes your A. The A is easier because you can actually deal with A even if you got the tax computation wrong. So A is easier. The annual market rent minus the employee's contribution. If the employee's contribution is on a monthly basis, don't forget to multiply by 12. Then you compare that with B. That's where problems start. Because ideally, if you go to your chargeable income in the tax computation, if you go to your chargeable income wrong, then you also get the B wrong. Because what does B say? Remember, I have my tax computation here. Assume this is my tax computation, where I've been adding all the items, I've added all the items, and I have gotten to this place called chargeable income. But when I was getting to that chargeable income, there is one item that I have not yet added in. And that item is called what? Housing benefit. So it means if they give you the housing benefits, please do not get the total in your answer. Don't write the total in your answer. First write it on the side. So you have all the other items. You only press an item of housing, but it has no figure. So if I know that they have given you housing, I put an item called housing benefits, but I don't put a figure there because I have to do it last. So I put all the other items other than housing benefits. So I come and first get my chargeable income, but I don't write the total there because I want to use that figure somewhere. So I come and do my working for housing benefits. This is how I'm going to use that figure. So in B, I am going to get 15% into brackets. Please write that formula if you don't have it. So I will get 15%. I open my brackets. In the bracket, I am adding two figures. Which ones are those two figures I'm adding? This chargeable income that I picked here, plus the figure that I have calculated in A, in this A. So in the formula for B, where we are saying 15% of employment income, including the amount referred to in paragraph A, is what I'm trying to explain. So I get 15% times brackets. I first combine two figures. What are the two figures? The other chargeable income plus the figure that I have calculated in A. For example, the example I've been giving you, you said A, the annual market rent was 24, employee contributed 2, meaning that is 22, not so? So I bring that 22, I add it on the chargeable income. The figure that I get, I multiply by 15%. Now I have two figures, one in A, which was 22, and then the one that I have calculated in B. When I get these two figures, I choose which one is the lesser of the two. I choose which one is the lesser of the two. The lesser of the two becomes my housing benefit. And then once I get the lesser of the two, I go back to my calculation. Where I had pressed housing benefit, I go and press it. I press that amount there. And then I re-add my chargeable income. Have we got it? Good. Finally, I want to look at the loan. The loan. Do I have the loan formula here? Or I need to create it? So I can add another formula for the loan benefit. So item number one on the loan benefit is that the loan must be above 1. The loan must be above 1. So you're looking for two things, actually 3 things. When you're calculating the loan benefit, you're looking for 3 things. Number 1, you're looking for the loan amount. Loan amount. Assume the loan amount is 10 million. Number 2, you're looking for the statutory rates. Statutory rate, statutory interest rate, statutory rate. Now, with the statutory rate, the examiner can confuse you by giving you the rate at the commencement of the year and the rate at the close of the year. Ladies and gentlemen, we are looking for the rate at the commencement of the year. So the statutory rate at commencement of the year. Number 3 is the interest rate offered by the employer. So loan amount should be above 1 million. Let me use that for guidance purposes. So it should be above 1 million. So these are the ingredients that you need to get the loan benefit. So how do you get the loan benefit then? The loan benefit would be loan amount times, into brackets, the statutory rate minus interest rate offered by the employer. So, if the employer gave you an interest-free loan, what rate has he given you? 0%. And if the statutory rate is 10%, it means 10 minus 0. Then times the loan amount. That becomes the loan benefit. If the employer has given you 4%, but the statutory rate is 12, 12 minus 4 times the loan amount. That becomes your loan benefit. Now, for these benefits, accommodation benefits, motor vehicle benefits, and the loan benefit, if you're calculating a number on monthly basis, you first calculate them as they are, but then divide by 12. So the motor vehicle benefit, that 20% represents the whole year. So you calculate it as if it's an annual benefit and then divide by 12. The loan interest, any interest is representative of 12 months. You calculate it as is and then divide by 12. That is all you need on employment income number. Anything else, you'll be doing it on your own. But that is all you need on employment. And I find it as one of the easiest. Now, before you move, sometimes I don't take things for granted. I want you to look at your employee, rather the individual rates. Look at the individual rates. Look at those individual rates. Are you there? Are you there on the individual rates? Largely speaking, you're going to be using the last band. And be careful not to pick the non-resident rates for resident rates. It's very important to know which rates you are using. For example, these are the rates. They have both residents and non-residents. If you're doing one number that is for an employee who has been in employment for 1 month and it's an expatriate, then you're going to use the non-resident rates. If you're doing an annual, then don't bother with the non-resident rates. You're going to use the resident rates. And largely speaking, you're going to be using the last band. The last band that says exceeding 4,920,000. But they are saying in that band, there are two rates. For people who are earning more than 120 million, and for people who are earning less than 120 million. If your chargeable income for the whole year that you've calculated is more than 120 million, you're going to apply A and B. You calculate as if it is A, and then afterwards calculate B and combine the two. If this person is, the chargeable income is less than 120 million, you only apply A. Are we together? So I'm going to give you two questions, and you give me the two answers. One employee, the chargeable income was 110. And another one, the chargeable income is 150. Get the answer. Once you get it, then you know how to apply those rates. Once you get it wrong, then go and practice. And that will be the end of employment income. So the first one, calculates as if the employee chargeable income is 110. And the other one is 150. So we say the one who has less than 120, you only apply A. The one who has more than 120, you apply A and B. Please apply, because no one is going to apply it for you in the exam. So you have one who has 110 million, and another one who has 150 million. Get me their tax liability. And they are all residents. And this is for a year. You actually calculate it as if it were a year, and you also calculate it as if it were a month. So I want you to get for me the annual liability and also the monthly liability, if it was a month. Assume there's the same amount, but one is earning it on a monthly basis and another one is earning it on an annual basis. What would be the answers? What would be the tax? This is chargeable income. If your neighbor is the one calculating for you, you know you're in danger. We are only left with how many days? 4 days. Have we gotten it? So if you've got it, we are going to do it together and see whether we get it. You got it right. So where you have less than 110 on a monthly basis, we said you first get 300,000. 300,000. You add 30%. 30% times what you have as your chargeable income, 110, minus that threshold of 4,920,000. Sorry, this is 300,000 in two brackets. Did you get that? Anyone who did not get that? I could also be wrong. Did you get the same? Anyone who has not gotten that, don't sleep. Simple means you've not yet understood how to get it. So we are getting, you get 300,000 plus 30% of the difference between your chargeable income and the threshold of 4,920,000. If it was a monthly basis, it is only this that is going to change. The 300,000 becomes how much? The 300,000 becomes what? 25. So on a monthly basis, 300,000 becomes 25. And then the 4,920,000 becomes what? 410. Sindio? Sorry. So that is it. So on a monthly basis, if you are calculating it on a monthly basis, it will be 25,000 plus that 110 million minus 410. So the one who is actually calculating it on a monthly basis, in the Bible they say when the children of God were have you got it right also on a monthly basis? Any challenge? Yes. Pardon? You do what? Yes. I said the 110 is now received by this person, but for a month. This guy is earning 110 for a month, or is earning 154 a month. That is what I meant. So we have the same person, or we have two people. One is earning it for a year, another one is earning it for a month. But that's how the numbers would work out. So the second one who is earning 150 or 15, this one I must separate them. One is earning 150, another one is earning 15 million. Another one is earning 15 million. On a monthly basis, 150, rather on an annual basis, 150, on an annual basis, rather monthly, 15 million. Use this example. So on annual, assume this person is 150 million. But when it comes to the month, he earns 15 million for a month. How much would be the tax? For the guy who has annual 150 million, how much would be the tax? You've already gotten the answer. Let me also get my answer here and see. And we compare notes. For me, my formula here says 28 million. Did you get 28? For the annual. For what? Oh, mine is wrong. Let me confirm it here. Hey, this one was 110. Sorry. It's supposed to be 150. Is that correct? Again, it's wrong. So what is making it wrong? Let me see. It is 0.3, 150 minus 4,920,000. That gives me that. I multiply by 30%. That gives me that plus 300,000. 43. Then plus 43 plus 3 plus 150 minus 120, that is 30 times 10%, that becomes 3 million. So the answer should be 46,824,000. Is that correct? So what you got? Guy, you're too sharp. Then the next one would be the one who is earning 15 million per month. So 15 million, so 15 minus 410 times 30% plus 25,000 plus 300,000. How much did you get here? I'm getting 4702,000. Are you getting any different answer? You're getting a different answer. What are you getting? With 15 million, guys. No. When you look, guys, when you're looking at the monthly basis, the 120 becomes 10 million. The 120 becomes 10 million on a monthly basis. Thank God I tested you on these ones. Please pay attention to this. Please pay attention to this. When we are looking at a monthly basis, the 300 becomes 25,000. The 4,920,000 becomes 410. When it comes to amount that exceeds 120 million on a monthly basis, we are looking at 10 million. And the 120 becomes 10 million. So if I am looking at, for example, one who is earning 15 million, if I am applying A, it would be 25,000 plus bracket 30% times the 15 million minus 410. I first get my A. When it comes to B, I get 15 minus 10. And that difference I multiply by 10%. See? So do we get this, or I am still wrong? I am still wrong. So if I said we are getting, let's do it together. My chargeable income is 15. I am removing, let me do it here. My chargeable income is 15. 1, 2, 3. Minus the 410. Then on this figure, I multiply by 30%, 0.3. And on that, I add 25,000. Becomes, my first A becomes 2,000. And then I need to add 300,000. Huh? 500 is 15 minus 10. I don't know where I was getting the 300. So 500,000. So this becomes 4902. 4902,000. Like that. Great. So this is practice that you must make, definitely. There's no one who is going to make it for you. Okay, so it's one. We are going to go for 1 hour break. And then we run the milestone. When we come back, we are going to attack the next line on the agenda is VAT. So I know when you eat, you doze. I am going to make sure that you stand up when I see you dozing in the afternoon. You stand up and study while you. Okay, so guys online, we are going to have a break for just 1 hour and we'll start. So if you're not here, we'll go. Okay, so go and enjoy your lunch.